the volatility and the rotation that we're seeing among single names is healthy.
The breadth picture under the surface for the S&P 500 is actually starting to improve.
The Mag 7, they just have to sort of behave, right, in order for the market not to have, kind of one of these major scares.
I think equities are still going up 15 to 20% from where they are over the next year.
This bull market deserves the benefit of the doubt.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday with markets on edge. Investor jitters around mega cap tech, taking stock markets lower as a chorus of Fed hawks is leaving a December rate cut firmly in doubt. The doves get a data point. Verizon discussing plans to make some major job cuts, up to 20,000 jobs on the chopping block.
And that's a significant part of their overall staff, which is about 100,000, just to give you a sense. And it comes after a leadership change at that company that happened a couple of months ago. This goes to the ultimate question, though. Verizon is cutting jobs as it tries to compete on price. It can no longer pass along price increases to consumers. How much does this highlight how much companies are grappling with the fact that they're reaching the limits of consumer tolerance of higher prices and have to make efficiency changes that are hitting the job market?
We keep getting these contradictory headlines in the labour market as well. It's really confusing. You take a big headline like that, super flashy, very concerning. Then you compare it to something boring like state jobless claims. State jobless claims say everything is okay in the labour market right now, and that's some fuel for the hawks into next month.
Most labor creation comes from smaller businesses. That is the reason why this is so complicated. You can get some high-profile large businesses that are making efficiency pushes, but this is what they always do. And this can be idiosyncratic. It is not where the most of the labor market growth really happens. It's the reason why so many people say, watch for the vibes, but really listen to the data. The fact that we haven't gotten data, we may not get data that we're looking for, really muddies the picture that much more.
The vibe shifting around the Federal Reserve. Let's talk about it. The hawks making lots of noise in the last 24 hours. At the end of August, the start of September, the Fed starts talking about risk management interest rate cuts. The market gets excited about a cutting cycle. Here we are facing the prospect of a prolonged pause, and maybe for the duration of Chair Powell's term as the chair of the Federal Reserve.
So I was looking at Fed funds futures back just before the last Fed meeting about a month ago, and it was above 100% chance that there would be a Fed rate cut in December. You take a look now, it is less than 50% for the first time since that meeting. Suddenly, people are saying there is a greater chance of the Fed not cutting rates next month than actually cutting rates because of the pushback that we got from Cleveland Fed President Beth Hammack or St. Louis Fed President Alberto Musalem. And there's a real question here about how much they really do have the upper hand as inflation does remain above that 2% goal.
Do you think that was the objective? I'm pleased you've gone back to that news conference. Wasn't that the objective of Chairman Powell, to make this a coin flip? A 50-50 bet for December, and a market that didn't really fully internalize the message in that news conference. And it's taken a flood of hawkish Fed speak in the last day or so to really get us back to maybe where he wanted us to be.
This is what a lot of people are speculating, which is the reason why they're saying bet against this. They're still going to cut rates because this is just wonderful messaging to try to take some of the froth out of the market. That said, it does seem like this Federal Reserve wants to go slower without the government data, and it looks like we're not going to get the government data. The idea that we could get the jobless, the overall job creation from the non-farm payrolls, but not the employment rate, the unemployment rate, raises a question about what kind of value this data actually will have.
Before we get into it, here stateside, let's just spend a couple of beats on what's happening in the UK. This is the price of chaos. The price of chaos and uncertainty is volatility, and it's been a very volatile session for sterling assets over the last 24 hours, both for sterling against the US dollar and for the bond market as well. Back and forth over what policy is going to look like in the budget in the coming weeks. This has been a problem that's been building for months now.
Yeah, so they're between a rock and a hard place when it comes to Rachel Reeves, the UK Chancellor of the Exchequer, and she was expected to raise taxes yet again, I think the third time in 3 years, even after pledging she wouldn't do so. Now she's trying to back away from that, potentially. That's some of the news this morning that's coming out, and it's raising questions. Is this a good thing or a bad thing for the fiscal backdrop, given that there aren't credible means to cut spending? At this point, they're in a bad position, and the market's getting whipsawed by, frankly, just fiscal instability, a lack of any kind of fiscal structure of exactly how they're going to maneuver.
This is one of the most disruptive budgets I've ever seen, and we haven't even seen it yet. That's how ridiculous things are in the UK at the moment. Sterling all over the place. Coming up this hour, George Goncalves of MUFG as the equity market pulls back, Francisco Blanch of Bank of America on the energy risk for AI data centers, and the former BLS commissioner, Bill Beach, on a month of missing economic data. We begin this hour with stocks already steady, heading lower after notching their worst day in more than a month. George Goncalves of MUFG writing, market internals are starting to look exhausted and ripe for at least a correction. We think many of the positive catalysts are priced in, whereas the weak consumer and credit concerns are not. George joins us now for more. George, good morning, sir.
Good morning.
Have you ever seen such a freak out about a 2 to 3% pullback on the S&P 500?
It seems worse because it's been easy sledding all year long after Liberation Day, right? It's been up and to the right. And I think this is a critical time point. We're coming towards the end of the year. There's been a lot of gains had in many different asset classes. I think this is when investors start to discern, do they take chips off the table? I think that the last couple of days is reminding them. I mean, the last week and a half, to be honest.
What do you think's changing? Lisa and I were talking about this. The chairman clearly had a message in the news conference at the last meeting. Do you think the market failed to fully internalize what that message meant?
I do think there's an element of the Fed at play as well. I mean, like the rates market, the bond market has been pricing in cuts for quite some time, and now we're at this kind of 50-50 injunction. I do think that if the Fed does not deliver on the easing that's been promised or at least expected, the markets are going to reprice, all markets.
Do you think this is a Fed story, or do you think this is more a change in the AI story from a pure play on the potential hopes and dreams to one that is more debt-fueled and more speculative with leverage put on top of it?
Even if that's the case, and I have my concerns around that as well, I do think that the cost of funding, the time of the year, all these great P&L all throughout the year, that we're getting to this point where, if the Fed doesn't deliver cuts, I think it's probably weighing on the psychology.
Okay, so why aren't we seeing the biggest drawdowns in some of the more cyclical plays? Why are we seeing the big tech names hit hardest? Which is the reason why I'm pushing back. I'm trying to understand exactly, do we need to have a narrative for this? Or is this just basically some people taking the chips off the table?
Yeah, so I mean, look, the narrative always shifts, as you know, and the narrative and the reality as well, technology is a long duration play, always was. And if they went from using free cash flow to using debt, and interest rates will start to matter at some point, and so will spreads. And there's been actually a widening of spreads within that category. So I do think there's a fixed income component, not purely Fed and fundamentals, but I do think that if they're becoming long duration assets, they're going to swing with rates.
Do all of these forces, the forces I'm talking about, Lisa's talking about, do they put the year-end rally in jeopardy? Is that year-end melt-up now at risk?
Well, we're going to go through many mini cycles before we get towards the typical year-end seasonal type rally, which typically kicks off closer to Thanksgiving into the end of the year. I think it comes down to the data. And we're going to, at least now, finally, with the government reopening, we're going to get the data.
Some data.
Not
all of it.
Not all of it. But I do think the burden will be there, that the burden of proof is there, that, you have to have really strong jobs data to turn off the Fed. Even though they're talking tough, I think they're still going to cut, is our view.
Can we just get into the data and why we're not getting the household survey? What is it about that particular survey that makes it difficult to produce?
Well, I mean, I think it's the actual collection process. And let's also take a step back and realize the BLS has been, has had staffing issues all throughout the year, getting people back in place, collecting the surveys, doing the household. It's much easier to do the establishment NFP.
What's your sense that this data would come in stronger than expected or weaker than expected based on some of the peripheral information that we have been getting?
Yeah, I think that the alternative data that we've gotten throughout the last 6 weeks still points to a weaker labor market. So I think that once that's clear and you see it, it's going to be hard for the Fed to back down.
So if the Fed does cut rates, where is the outperformance going to actually come from if it really is in response to a real problem, right? It's sort of this idea that be careful what you wish for when the Fed actually does cut rates because they could be responding to a real issue.
True. I think if it lingers into Q1. So if the Fed cuts rates because we've been kind of in this lull of no data, vol's been very low, there's uncertainty about what the outlook is. If they're cutting because there's the persistent weakness is one thing. If it's an accelerated weakness, I think that probably shows up more in Q1 than at the end of the year.
Oh, you don't buy the pickup in Q1 next year? Because that's what this market's priced for. That's what Fed President Muslim's talking about, a re-acceleration in Q1 26. Why don't you buy it?
Well, I mean, as both you in your opening intro, I mean, yes, small businesses should be leading the charge. But if you look at the NFIB surveys, you're not seeing that pick up yet. And they're the most rate sensitive. So you need to get rates much lower to get them to actually start to hire and not just be reacting to the fiscal policy that's been put in place. And look, let's not ignore the layoffs have been huge, and they keep coming through, even heading into the holiday season. And the seasonal sort of hiring plans aren't there. So the jobs market, in our view, still gets worse before it gets better.
They're real. That headline for Verizon was super concerning. The initial report, I think, came from the Wall Street Journal and said up to 15,000. And 4, 5, 6 hours later, that number went up 5K. That's super concerning.
Especially given the fact that it's trying to compete on price. This is because Verizon has fallen behind when it comes to attracting new consumers because they've tried to just raise prices on the ones that they're keeping. They can't do that anymore, which highlights really the state of some of the weakening that we're seeing.
Hiring intentions elsewhere aren't exactly robust for that 20,000 job cut pool to go and find a job immediately afterwards anyway. That's the problem. In a low churn labour market, to have those kind of layoffs, where's the pickup going to come from?
The real question, though, going forward is how much will Fed rate cuts change that, right? How much is this something that is structural or cyclical? This has been the big debate on the Fed, and frankly, this is the big debate in markets. How much are we seeing a new efficiency ploy that's going to somehow reduce the need for human labor that's going to really skew the numbers in a material way?
The S&P this morning, session lows now. We're down by 0.5% on the S&P 500. George Goncalves of MUFG is going to be sticking with us. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Donald Trump is preparing substantial tariff cuts to address high food prices. The president unveiled framework agreements with Argentina, Guatemala, El Salvador, and Ecuador to reduce tariffs on common grocery items. The deals will reduce tariff and barriers on items like beef, bananas, and coffee beans in a push to lower costs. Meanwhile, new data out of China showed cooling economic activity at the start of the fourth quarter. Investment slumped at a record pace for the period, while industrial output saw its smallest gain since the start of the year, and retail sales slowed for the 5th straight month. And UK bond yields are paring losses after Chancellor Rachel Reeves dropped plans to raise income taxes. The change came in response to an improved fiscal forecast from the UK's budget watchdog. The country's fiscal hole was found to be closer to £20 billion, while expectations were as high as $35 billion, which still may require major tax rises to tackle in the future. That's Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, fixing affordability.
I want to address the affordability issue.
So we understand that people still feel the pain.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again.
That conversation up next with Bloomberg's Mika Sona, live from New York City this morning. Good morning. Stocks are down. We're down by 0.5% on the S&P 500. On the Nasdaq, check this out, down again by 0.9%. And check out what isn't happening. There's no bond market rally. Check out fixed income, 2s, 10s, 30s, yields up by a single basis point and 10s, 412.89. That's something new. We've talked about bonds doing what bonds are meant to do recently. Not happening in the last 24 hours.
And part of this could be, you could say this is part of the Fed move, the idea that the risk-off mood stems from the Fed being more reluctant to cut rates as a given in December. There also has been a different tone under this particular sell-off, which is you're seeing a commensurate sell-off in some of the corporate credit tied to some of the big tech names. That's new. Real pushback suddenly from debt investors who are saying, hold on a second, what are we paying for?
Everything that was doing so well is facing pushback across the board, and I'll throw in crypto as well. Bitcoin's had a terrible go of it too. If you've had a good year, you've had a bad few days. That seems to be the story at the moment.
Momentum has really struggled, and I think that raises this question, is that the beginning of something deeper? Or are we starting to see that rotation that Mike Wilson of Morgan Stanley was talking about? Interesting that the NASDAQ is underperforming the Russell 2000. You're seeing the equal weight actually outperform for a consistent stretch of a number of days. So it raises this question, is this the beginning of the new stretch, which is a positive, or is this the beginning of a downturn that reflects a weakening that's a negative?
Equity futures this morning down by 0.6%. Under surveillance this morning, fixing affordability.
I want to address the affordability issue. The Trump administration has taken aggressive action to fix the Biden-created cost of living issues.
So we understand that people still feel the pain. We see really high wage growth and inflation is much more under control.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again.
So here's the latest this morning. President Donald Trump preparing new trade deals and substantial cuts to tariffs as the administration looks to ease affordability concerns. Joining us now is Bloomberg's Mika Solna. Mika, this is a bit of a pivot coming from the White House over the last week or so. What's behind it and what are the steps they're willing to take?
Yeah, absolutely. After the results of the election earlier this month, I think the White House is really looking to hammer the affordability, cost of living message that Democrats have done so well on. President Trump has essentially blamed any kind of economic downturn on his predecessor, Joe Biden. But right now, I think the circumstances that millions of Americans are feeling when it comes to their pocketbook is really catching up to them. So the administration is really trying to scramble here and find some ways to make that their winning issue.
Mika, how did they massage the messaging? Because the takeaway for a lot of people is going to be, you're focused on affordability and your first move is to drop tariffs. Aren't you acknowledging that tariffs are damaging affordability?
Well, one way that the White House is really trying to mitigate that is the idea of a potential tariff stimulus or surplus checks going to Americans with an income threshold that would qualify for that, similar to the COVID stimulus bill. Other areas that the president is looking to is potentially a 50-year mortgage. And there's other avenues, I think, that the White House is still exploring when it comes to trying to message and play up the message of affordability.
Mika, I appreciate the update. Mika Solna in Washington, D.C. It's a problem, isn't it? It's a real problem.
You can't say that you want to remove some of the tariffs to address cost of living issues while also saying that tariffs don't cause inflation and have no impact on the price of goods. This is a conundrum for them, and it raises issues, frankly, for the Supreme Court case. How do they argue this is a national security concern if they can remove the tariffs because of an affordability issue? There are a lot of questions here, and it raises a real issue longer term for how they deploy this in a strategic way.
George Goncalves of MUFG is still with us. George, this is a challenge for the economic marketing wing of the White House. Kevin Hassett has to dance around this carefully. But what's your conclusion based on the past few days?
Look, a few things. One, the tariffs do matter because not everyone's consumption basket is the same. So there's an acknowledgement if the food component for some cohorts matter more than others, then clearly that's obviously the way you address it. Number two, the tariffs haven't fully been implemented. I mean, we've obviously benefited with some price rigidities throughout the year. There was a lot of inventory pull-through and hoarding of goods. We're going to see we still believe that the tariffs are going to still filter through over the next 3 to 6 months. And the saving grace for the U.S. is that we consume only 20% of goods, and most of it is still services, right? So we're still getting the disinflationary from the rent side, from wages not going up. But I think it's going to come through, and I think it's clearly an issue. And the second point, which the bond market, you have to be careful here because the bond market the saving grace for the bond market has been the tariffs. Ironically enough, it's been a revenue source.
True.
So if you're going to then shift to a sort of stimulus using tariffs, the bond market will then reprice, and then there goes all your benefit.
People are have sympathy for the national security objectives of the tariff push. I think people are sympathetic with that issue, one. But two, I don't mean to be flippant about this or snarky, but don't go after people's coffee. This is the pitfall of doing everything all at once on everyone without a nuanced approach to the kind of things that, you don't make here in America. You don't develop enough. You don't grow. That's the problem.
Yeah, avocados, bananas, coffee. Every morning, everyone goes and gets their coffee. That's sort of a barometer for how much prices are going up. But again, this goes to the idea of how much the recognition of the public opinion and how much it's declined on some of these cost of living increases, how much it's affecting the politics. How much are we underestimating how much that's going to really affect policy going forward?
The Supreme Court's another issue as well. They might strike down a lot of this by the end of the year. You throw in the fact that the Federal Reserve isn't going to be cutting or hiking anytime soon. They're just going to stand pat. You've got an administration backing away from tariffs. You look at this bond market. Now, George, what are the risks around fixed income for the new year?
So that's the challenge, right? That's why I was making this point that it's been a good year for most asset classes. Even treasuries rallied, right?
Yields have fallen.
Look, and that's been our view, by the way. We were out of consensus. We were pretty much bullish duration. But the fact that we keep stalling at that 4% level, it's going to be hard for rates to rally if we're seeing these sort of, indecision either from the Fed or what's going on the fiscal front. The bond market, I think, is in this sort of impasse that could, see a backup in rates, easily 25 basis points.
Well, this is what a lot of people have been debating on this show. whether we're going to see some sort of stimulus next year, early next year, that's going to cause yields to go up in anticipation of inflation, anticipation of stronger growth, or if that stimulus extends to monetary stimulus and the use of the balance sheet to suppress yields, even if that is the potential ramifications. How are you playing that out?
Yeah, it's a timing issue ultimately, right? And of course you can throw in there, Chair Powell's in play until at least May, and then what happens after that? There's going to be a big timing issue. So, like for us, it's more about the forward curve and how the forward curve is signaling that rates are actually going to head higher in like 26, 27. Slightly, the lower sort of terminal rate has been shifting up above 3%. And if you look at the forward curve in 27, 28 is already at 325. So like you're already starting to see like the market saying, hey, it's going to be hard to pin rates down.
At the same time, yesterday we saw something new, at least versus the past couple of months, which is the return of the Sell America trade. We saw it with respect to bonds. We saw it with respect to AI. We saw it with respect to the dollar. And I'm just wondering, do you think this is going to come back, or do you think this is a momentary blip until people realize that everywhere else it's not so much better?
I'm not sure if all the asset classes will stay in unison like that, because if we do go into a more an actual slowdown that's more visible and present and the labor market to us is so critical that eventually the bond market would catch a bid. But in this period of indecision where it's very ambiguous, you don't know where you are, and you have this fiscal uncertainty, I think that all asset classes can go down.
What's your assessment of where the labor market is right now? What's a good jobs number? What is a bad jobs number? What is the break-even rate? What's the range of estimates for you and the team?
No, look, and that's a moving target, and it depends on a number of factors. We're still, and of course, we may not get the unemployment rate. So we're more focused on the unemployment rate and the lack of, there's a lot of entrants that are not coming into the jobs market. I mean, if you look at the youth unemployment, that is a shadow unemployment rate that's, really not filtering through to claims data. Like claims data, if you don't have a job, you can't go and actually get the claims, right? So like all these things have been altered, and so you're not really getting a good sense. I think that, anything like around 50,000+ NFP.
50 plus gets it done, keeps a lid on unemployment.
For the most part.
Yeah?
Yeah.
The problem is that we're not going to get unemployment.
Right.
Has the Federal Reserve put out where they think the break-even rate is and what they think is a good number? I'm trying to work out what the guide's going to be for December 10th. We will get payrolls. We won't get unemployment. What's a good number? What's a bad number? What leads this Fed to cut interest rates?
I mean, the federal work numbers are going to work through there as well. So we're probably going to get a really weak NFP, at least for October. And September could be pretty weak as well.
What's your highest conviction trade heading into the end of the year?
So, I mean, we like being underweight credit at this point because how much of it's been priced in. Even mortgages have performed. So even mortgage spreads are too tight. Basically, staying very defensive down the curve, and anything beyond the 7-year point on the Treasury curve, I think, is at risk, which will then amplify IG losses as well as mortgages.
So what do you like?
Just short-term securities.
Short-term securities and just cash. Essentially, you're packing cash into your mattress and expecting for the worst. Is that right? Well,
sort of. But I mean, it's more of that. It's defensive in anticipation of if we get the sort of weakness in the macro front, then you can redeploy. So I think, it's more about just trying to look for a setup for next year.
A super bearish George Goncalves of MUFG. Thank you, sir. Good to see you, George.
Sure.
George didn't say that, but that's my conclusion for anyone sat at the front end of the curve, parked in cash, waiting for bad things to happen.
Yeah, so that you can come in and buy. I guess that's the one silver lining, is that potentially there could be better valuations that come down the pike. But there is this feeling that right now there's a dichotomy between those people who say, look, this can't continue. There's too much froth that potentially needs to come out of the market before we can get in. And those people who say it's a Santa Claus rally. People are going to feel like they missed out after 20+% earnings in the NASDAQ overall. They've missed the rally. The FOMO is going to get everyone back in. And ultimately, that's the debate heading into year end.
There's nothing festive about this move so far this morning. We're down by 0.6% on the S&P, and it's not coming with a rally in the bond market. Yields on 10-year treasuries are just about unchanged now on the session. Coming up on the programme, in the next segment, we'll catch up with Francisco Blanch of Bank of America on the limitations threatening the AI data center build-out. Plus, Hauer has some of the morning movers for you. StubHub plummeting after its first earnings report since going public. That stock is down by 19%. Live from New York City, you're watching Bloomberg TV. The losses continue. We're down by 0.6% on the S&P, on the Nasdaq 100 down by 1%. Session lows. We snapped a 4-day streak without losses on the benchmark stateside in yesterday's session. The biggest one-day loss going back to October, so the biggest one-day decline in about a month. On the Nasdaq, session lows and down another 1% so far. Turn to the bond market. Look what's not happening. No Treasury market rally this morning. 10-year bond yields just about unchanged at 4.1250. 2-year bond yields at 3.5849.
You can say this is because of the Fed. I'll bring another aspect to this. Yesterday, we got that 30-year auction. I was saying that it was going to be exciting. It was exciting. There was actual pushback, and it led a sell-off in the long end of the yield curve that moved into the corporate debt market, where there has been some longer-term debt that's been sold. So how much is this what's at play versus actually a Fed rate bet?
I'd throw in the hawkish chorus as well in the last 24 hours. I think it's material. And clearly there's an objective here. To get the odds for December back to a coin flip. Because I don't think this market fully internalized the message coming from the chairman in the last news conference.
And you can see from Fed funds futures that it went from more than 100% chance of a December rate cut right before the October news conference to now below 50%, to that coin flip that you're talking about, as we hear this churn of different Fed officials coming out and saying inflation still is a real problem, and that is our priority.
That's the story, the front end of the curve, as Lisa pointed out, the very long end of the curve. Check out 30s this morning, up another 2 basis points, 4.73. That's the cross-asset setup so far this Friday morning. As we count you down to the open in about 3 hours away, let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with Warner Brothers Discovery. Shares are rising 3% in the pre-market on growing conviction a buyout could materialize. That's because the Wall Street Journal is reporting Paramount, Comcast, and Netflix are all preparing bids ahead of a November 20th deadline, with Paramount eyeing the whole company while Comcast and Netflix are eyeing the studios, HBO Max, but not its cable studios. And we move on to Applied Materials. Those shares are falling 5.5% in the pre-market after reporting another quarter of falling sales. This is a company that makes the machines that make semiconductors, and they say that U.S. export curbs to China are weighing on sales. It expects that drag to continue into the current quarter and doesn't expect a pickup in demand until the latter part of next year. And we end on a big mover to the downside, and that is StubHub. Shares are falling 18% after delivering a much bigger loss than Wall Street expected in its first earnings report since becoming a public company. Revenue and ticket volume did come in solid, but shares started to plunge yesterday on the earnings call when the CEO said that they would not give a 2026 outlook just yet, despite him insisting that demand for live ticket events remains phenomenal. John?
Brutal move. Yahira, thanks for the update. Appreciate it. On our radar this morning, the White House readying substantial tariff cuts to everyday items as it ramps up messaging on affordability. The cuts coming through trade deals with Latin American countries that export items like beef, bananas, and coffee beans. Elsewhere, Fed officials casting doubt on a December interest rate cut. Minneapolis Fed President Neil Kashkari saying he didn't support the central bank's latest interest rate cut. Plus, Cleveland Fed President Beth Hammack sharing a similar take.
I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
The comments highlighting a growing divide among policymakers.
Ultimately, they're hamstrung between the idea of a labor market that does seem to be slowing and inflation that still is above target. What Beth Hammack of the Cleveland Fed said, though, I think is really interesting. She pointed to Fed credibility. She said, how can the Fed maintain its credibility if it doesn't prioritize getting inflation down to 2%? That ultimately may end up being the quagmire. How much does the Fed look at the dollar for a tell on exactly how much this is a Fed credibility issue versus maybe just a usual monetary policy decision? But that seems to be preeminent in some of their discussions.
It's funny, isn't it? Because those comments from Beth Hammack make the process appear to be more credible, even if they do decide to cut interest rates with inflation closer to 3 than 2.
Oh, what a skeptic. I love it. This is actually what a lot of people are saying. You're absolutely not wrong. And I think that a lot of people are saying the same thing. It sounds so good. Doesn't this actually do exactly the job that people were expecting the Fed to do, which is they're still going to cut rates, don't worry, but they're going to try to make it seem like it is a very deliberative process that really is somewhat tortured.
I don't think the division is contrived. I think it's real. I just think that the optics are valuable right now, because the inflation story, look, you'd look at markets and you'd still say that inflation expectations are still well anchored. Well, thank goodness we have people like Beth Hammack on the committee to make sure that we just pull back the individuals that would like to go 50, 50, 50 every single meeting and get us down to 2 point something almost immediately with inflation closer to 3 than to 2.
I'll add to that Stephen Myron, who is the Fed governor, who's thought to be the Uber dove, who wants to cut by 50 basis points, came out yesterday and was talking about how he's concerned about overuse of the balance sheet. So if you want to take a look at even the Uber doves coming out and really expressing some concern about overly interventionist policy, he's not alone. He's actually joining the chorus.
He's not running to be Fed chair. Just throw that out there. Equity futures this morning, session lows were down by 0.6%. Big focus on the labour market, of course, and this headline that came yesterday, Verizon discussing cutting as many as 20,000 jobs, downsizing the workforce by as much as 20%. People familiar with the matter telling Bloomberg the cuts could come at every level of the business. That one could hurt.
Yeah, and this one comes after a leadership change. Dan Schulman coming in as CEO. And one thing that he said was that they're going to take bold and fiscally responsible actions. He said, these will not be incremental changes. We will aggressively transform our culture, our cost structure, and the financial profile of Verizon in order to put our customers first. They are dealing with the fact that T-Mobile and AT&T have been eating their lunch. They have been lowering prices, and they have been getting a lot of new customers. They have not. So now they have to compete on price. Is this a telecom story, or is this a broader question of competing on price and making efficiency cuts in the process in order to deal with the fact consumers just don't want to pay up?
That is the argument of the doves right now in the committee, essentially. Everything you just said about Verizon is the argument of the doves on the Federal Reserve at the moment.
Which is the reason why they think that inflation is not going to pick up and that ultimately you have to prioritize the labor market. And this is a structural shift where they can be more efficient. That is the key. They can be more efficient and do more with less because of some of the technological advancements.
Verizon this morning in the pre-market higher by just about 0.2%. Let's turn to energy. The White House pushing for affordability while AI electricity demands remain poised to raise costs. Francisco Blanch of Bank of America writing, we are concerned that retail electricity affordability might cause politicians and regulators to slow down data center development. Francisco joins us now for more. Francisco, good morning, sir.
Good morning. How are you?
This is timely and very important. It's good to see you. Let's take a step back. What's happened to electricity prices in places like Virginia, where you've seen this massive data center build out?
They're going up. No surprise. Remember, ever since the beginning of mankind, we've tried to use more energy to reduce the labor input into any process, right? I mean, whether it's inventing fire or just electricity itself. And I mean, everything is about energy, right? Energy and technology are the main drivers of productivity. And we are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining in a way that's, to your earlier comment, we're seeing job reductions, but at the same time, we're going to see a massive increase in power bills.
AI is winning the PR fight on Wall Street. It's losing on Main Street. How do you convince people it's good for them when you build a data center like this in their area and you sit there and you say, look, this is what's happening. My job's under threat and my electricity bill's going up. What's AI doing for me?
Well, I mean, hopefully it's allowing you to repolish your skills and potentially facilitate a lot of the processes in your life. But you're right. I mean, where we're seeing the shortages in the skill base, it's really in more manual labor, and that's what CEOs are telling us, right? That's where the gap is people able to do things with their hands. One key example people bring up all the time is, well, it's not easy to apple pick, right? I mean, you actually need a lot of computing power to replicate apple picking, but yet for a human, apple picking comes just naturally.
How much does this muddy the investment process? As an investor, how difficult does this make it to say, look, I want to invest in electricity. I want to invest in building these plants. Right. If there is this policy uncertainty of how politicians are going to respond to rising prices.
So there's definitely going to be a concern, right, with prices rising. But also remember, it's not just about the power centers themselves. It's also about the transmission lines, the connection, the grid, the substations. There's so many things that go into the electricity network. They're very, very expensive to upgrade. And I think the key point people need to remember is that for the last 15, 20 years, average electricity demand has grown at 0.2, 0.3% a year. Now it's growing at 2 to 3% a year, 10 times the rate. So in order to accommodate that kind of demand growth, you need to invest very, very heavily. Or you can do what Texas is doing, which is deregulate and just go very fast. I mean, Texan power demand is growing at 5% per annum. You won't even find an emerging market that's growing that fast. But they've taken the view of like anything goes, right? So you can be highly deregulatory, like just super fast, or alternatively, you got to find a way to accommodate these data centers. But utilities have long-term contracts. They can't give away on them. Otherwise, the lights would just go off. We wouldn't be able to talk right now.
This is fascinating because there is the potential deregulatory impulse coming from the United States, and you're seeing this pretty broadly.
Right.
You're not seeing that in Europe. And right now you're seeing a lot of pressures coming on the electricity side, not only from data center usage, but also just from some of the heating costs from potentially a cold winter. Why is it a better bet to expect energy prices in the UK and, frankly, in mainland Europe to go up much faster than those in the United States?
So one advantage, if you can call it that way, that Europe has over the U.S. is that Europe destroyed its demand for power in 22 and 23 with the Russia-Ukraine crisis and the big increase in gas and power prices that came on the back of the Russian invasion of Ukraine. So as Europe lost access to all that Russian energy, and of course, we also had an issue with French nuclear reactors that year. We ended up with a massive spike in prices, gas and power. So that hurt demand for industry. So Europe has plenty of spare capacity to ramp up electricity supply. And in fact, utilization rates for gas-fired power stations in Europe are 23% on average. I mean, so that means that 3/4 of the time, these gas plants aren't running in Europe. So they could bring those back. And of course, the other thing that Europe has going for it is that in the next 12, 18 months, America is going to export a lot of liquid natural gas, a lot of LNG. And that's part of the trade deal with President Trump and President von der Leyen. Europe is going to be buying a lot more gas from the U.S. and it's going to hopefully become cheaper after extremely high prices for the last 5 years. So that's one tailwind for Europe. Now, of course, it's a tailwind that comes on the back of a major industrial compression and 4 years of recession and quasi-recession in Germany. So it's not something that they were necessarily building, but something that Europe ended up with.
Throw in the issue that are also gripped by climate doom. Climate doomerism across the continent. I don't think it's surprising that Bill Gates came out recently and backed away from climate doom because he's got a big stake in building out a massive AI push across this country as well. And that's the issue. You've got a generation that has been indoctrinated by climate doom in Europe, and I don't see them backing away from that anytime soon. Do you? Look at the UK, great example of that.
Right. And Europe has been trying to pull back also from nuclear power. Many countries continue to try to shut down nuclear reactors. There's a couple of projects in between. People, we are a little bit over-reliant on gas and power, on wind and solar, and in the power sector. And I think the build-out in the last 4 or 5 years has created some vulnerabilities because there's been little investment in the grid in Europe, but very importantly, very little investment in what's called battery storage for power. So in California and in Texas, they've kind of figured this one out already. So they've invested very heavily in those areas. So you've seen as a result a better behaved power market in Texas. California is a bit of a different story because it's got other issues. But Europe needs to really step up on the investment in battery battery storage.
You've given us tons to think about. Yeah. What's the trade? What are you advocating for at the moment?
So we are generally bearish on European natural gas prices because we think all this wave of U.S. natural gas is going to push things lower. That's on the gas side. We are still constructive on things that you need to build those data centers, like copper. Medium term, we think copper is going to go to $15,000 a ton. Medium term, we still like silver. Silver is the best electricity conductor. Of course, it's already expensive. We think we'll go to $65 an ounce. And so again, more bearish on the gas, still bullish on the metals that are significantly supply constrained. And then I think on the oil side, we are maybe more on the bearish side here, although geopolitics are very complicated there, right? So,
final question. It's an important one for viewers waking up this morning. Is our coffee going to get cheaper or not?
Well, I mean that's a trade situation, right? I think eventually, Brazil is the biggest exporter of coffee, of beef, and biggest in the world. So, I mean, obviously, tariffs on Brazil don't help. But hopefully, the answer is yes. Agricultural commodities are beautiful in the sense that they tend to mean revert a lot faster, for the most part, with the exception of cattle. They tend to mean revert a lot faster than for example, metals, which can trend on forever because it takes 10 years to build a mine.
We hope you're right. Thank you, sir. We appreciate it. As always, thank you very much. Francisco Blanch there of Bank of America The AI build-out, the data center build-out, and the political pushback we're about to see in this country, I think could be quite severe based on what happens with electricity prices in the not-too-distant future.
Yeah, and one of the key questions is, what do they do about it? Is it with respect to putting a stop to some of the data center proliferation? Is it sort of capping some of the build-out, or is it just mass deregulation akin to what we've seen in Texas that allows a very rapid build-out of a lot of different electricity grids?
Equity futures this morning, session lows right now. We're down by 0.7% with an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Ukrainian drones attacked a giant Russian Black Sea oil port overnight, prompting the state of emergency. The attacks come as Russia has been ramping up strikes on power facilities across Ukraine, aiming to disrupt the country's energy system ahead of winter. Meanwhile, Amazon and Microsoft are lining up against NVIDIA. The Wall Street Journal reporting the two companies are supporting legislation that would require chip companies to satisfy U.S. demand before sending products to China and other countries subject to arms embargoes. NVIDIA is fighting the legislation. And the shutdown is over and paychecks are finally flowing with a bit of extra cash given to some federal workers. Homeland Security Secretary Kristi Noem announced TSA officers who worked without pay during the shutdown will be getting $10,000 bonus checks, calling the payments a reward for exemplary service under strain. That's your Bloomberg Brief. John?
I hope that happens. Yahira, thank you. Thanks for the update. We appreciate it. Up next on the program, waiting for delayed data.
The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed. So we will never know what the unemployment rate was in October.
That conversation up next with the former BLS Commissioner, Bill Beach from New York City. This is Bloomberg. Stocks are lower, negative by 0.75% on the S&P. We're down by more than 1% now on the Nasdaq 100. On the Russell, we're down by 0.85. If you turn to fixed income quickly, I just want to give you a snapshot of what's not happening in treasuries. Yields are up at the long end of the curve on 10s and on 30s. At least for the 10-year gap to about 413. As a level, 413 is nothing to be concerned about, but it's just the move relative to what's happening with risk assets that catches your eye on a morning like this one.
Yeah, there are a couple of different narratives. On one hand, this is yield curve steepening that's coming with the expectation that maybe the Fed will be more aggressive earlier next year, despite the fact that we are in something of a data desert and the fact that there has been this pushback. On the other hand, you are seeing supply concerns. And you're seeing that in a very real way, both on the corporate side as well as on the U.S. government debt side. And we saw that yesterday. How much is that percolating into some of the price action?
We'd like some data under surveillance this morning, waiting for delayed data.
The September jobs report has already been cooked, and we expect we might get that next week. The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed. So we'll get sort of half a jobs report. Most everything else, I think, we'll be able to concoct the correct number after we look back. But we will never know what the unemployment rate was in October because there wasn't a household survey.
So here's the latest this morning. Official economic data set to return after the record-long government shutdown. Delayed releases for more than a month. Joining us now, the former BLS Commissioner, Bill Beach. Bill, welcome back to the program. Can you give us some insight into how the BLS will be operating at the moment after a month-plus-long government shutdown? What the first order of business actually is?
Well, I think they turned the data systems on yesterday to sort of end that data desert that you just referred to. And so hopefully everything rebooted well. That's always a question. And then they have to ask about the field staff, how many people are coming back to work. You know, some of those people probably took early retirement or retirement. It's kind of an older staff anyway. We might want to talk about the CPI. But back to the jobs report that Dr. Hassett mentioned. Yeah, it is true. The jobs number, which is acquired from firms through an electronic survey, now BLS will prompt those firms to send their survey in electronically to Chicago or Fort Walton Beach, where those forms are collected. And we will probably have a jobs number for October. But the household survey, which is collected largely by calling people on the telephone and asking them a series of questions, quite a lot of questions, we may never have those data. And that includes not only the unemployment rate, but all of the breakout by race, by region, labor force participation, all those things that are really important for policymakers to follow. I'm also concerned about the CPI, but I think on the labor side, that'll be the biggest hole. I do expect the jobs report to come out for September, which was fully collected, but not quite written up yet. I expect that next week. I think they're right about that.
Well, you mentioned inflation a few times. Just describe the CPI process, the data collection, how that survey's put together, and why it's so difficult to produce that number.
So the CPI is collected from the first of the month to the end of the month. They put as many working days in there as possible. And it's largely collected, I'd say about 70% of all of the observations or goods, services, are collected by people going into stores. These are BLS employees, and literally going down the aisles and marking down the price and seeing how many, potato chips are in the bag. So it's a labor-intensive thing. Now we're starting that process probably next Monday. That only gives us 2 weeks to collect 4 weeks of data. Now, it is true that a lot of that data comes in electronically. The housing stuff, the gasoline, automobile prices, those are electronically produced data from private sources. So 30%, fine, no problem. But you can't have a CPI with only 30% of the data. So I'm worried about the CPI. I'm worried about the quality of the October CPI. So that's an issue, and we'll see how that works. The November numbers are also at risk because we're going to be collecting those November numbers as well as collecting as many of the data on the October side as we possibly can. That's going to be really dicey, but I think the staff is probably up to it. So let me just say, bottom line, no unemployment rate, no labor force data that shows the demographics, and I think people should be concerned about the CPI. The PPI is collected largely electronically, and of course the import-export indexes are entirely collected from administrative data from the Commerce Department.
Bill, just quickly here, how much are you seeing the reduction in staff for the Bureau of Labor Statistics just generally presenting a problem in both ramping up but also going forward presenting the same kind of accurate data?
Well, at the beginning of the shutdown, we had a really firm number. It was about 1 out of every 5 employees at BLS had quit. But there are 2 areas of really great concern. First off, the field, and I've mentioned that several times. So many of our data from the Employment Cost Index, which is field collected, the CPI, the household survey that does the unemployment rate, these are it's labor intensive. So you have to be really concerned for the 1,000 people basically who work in the field. We don't know how many of those people are coming back to work, honestly. They're largely an older staff, and that means they may have choices in whether they work or not work. And then the other area that I'm very concerned about is the senior leadership of BLS, about 31 positions that are absolutely crucial. And about 12, 13 of those we think are now vacant. That's the largest vacancy rate ever. And so this is expert knowledge that just can't be replaced quickly by going out to Indeed.com and finding some good resume. Those 2 areas I'm very concerned about.
Bill, thank you, sir. I leave this interview with way more concern than I had going into it. The former BLS Commissioner Bill Beach there on the difficulty of putting together this economic data.
Yeah, and going forward, what it means for the staffing levels at this key economic statistics agency.
The second hour of Bloomberg Surveillance coming up next with equity futures near session lows.
If you have the payroll number, but you don't have the unemployment rate, we don't really understand what the supply situation is looking like.
It's not a foregone conclusion that the labor market is in balance.
I think we still have enough information to say that the economy is still kind of muddling along.
There is enough evidence here for the Fed to continue to cut rates, at least one more time.
It's just this gradual ongoing softening that's keeping the Fed on edge.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores don't look good this morning. We're down by 0.7% on the S&P 500, negative on the Nasdaq by more than 1 percentage point. In the bond market, 2s, 10s, 30s. This bond market's not rallying. Yields are higher by a basis point on 10s, up by almost 2 on 30s. Over the next week, a big focus on the earnings. Nvidia, top of mind, but a major focus on the consumer. We should get some jobless claims next Thursday. And in the mix, numbers from Home Depot, from Target, from Walmart.
This is the perfect encapsulation of the K-shaped economy through some of the earnings reports that we're going to get next week. A real question for Walmart and Target of how much they're able to pass along their price increases to consumers, whether people are downshifting into lower priced items, other types of elements of concern that you would see at a point of some sort of inflection, particularly to the weaker side. On the flip side, we can get a gut check from NVIDIA. How much is the AI hopes and dreams of 2025 continuing to power all of the earnings that we're seeing in the AI sphere and can continue to deliver some sort of upswing to markets, even in the face of potentially softer consumer spending?
Just every day when you see this kind of drawdown, there's one stock I check. How's Apple doing? Apple just seeing some relative outperformance here and there when you have these kind of aggressive drawdowns. They were criticized about a month, 2 months ago for sitting out the massive CapEx spend, not leaning hard enough into AI. All of a sudden, some jitters around that story, and Apple's talking about a better iPhone sales story going into year end and the holiday season. And it looks like a relatively better picture now for that company.
Apple is oddly the uncorrelated tech stock because they didn't necessarily go all in on artificial intelligence in the same kind of way. So for people who are worried about the overbuild in data center land or potentially the overspend in Oracle and OpenAI land, well, Apple is not necessarily part of that because they're not Apple AI.
NASDAQ futures this morning down by 1.2%. Session lows right now in the S&P as well. We're down by 0.8%. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as valuation jitters rattle investors. Sarah Bianchi of Evercore as the White House pivots to affordability. And Alejandra Grindal of Ned Davis Research as Verizon moves to cut perhaps up to 20,000 jobs. We begin this hour with stocks losing ground. Victoria Fernandez of Crossmark warning against chasing this market. She writes, "We have seen this story before. Breadth deterioration coupled with bullish sentiment can lead to 5 to 10% pullbacks, and we wouldn't be surprised if the story repeated itself here." Victoria joins us now for more. Victoria, welcome. I'm going to kick things off with the same question that I asked George Goncalves about an hour ago. Have you ever seen a freak out like this one over a 2 to 3% pullback on the S&P 500?
Yeah, I mean, yes, we have seen these pullbacks before, and it was what you were just talking about. When we have that breadth deterioration in this market, when you have this internal weakness kind of bubbling under the surface, but at the same time, you have this, for lack of a better word, you have this exuberance, you have this sentiment that is extremely bullish. At some point, those two worlds start to collide, and you see this pullback. But look, Jonathan, we are still not that far below all-time highs, really, when we look at the markets as a whole. So I still think there's probably some room to see more pullback, especially when you're seeing small caps down as much as they are. We know the tech stocks kind of led this rally. We see them leading the pullback we're having here. But I do think some of the internal weakness is driving this. And the fact that the government shutdown is now over, I think investors are starting to look and go, wait a minute, we've been ignoring some of these facts that have been out here, some of these warning signs. Now they're starting to pay attention to it. And we're getting a little bit of a consolidation of a correction here.
This is going to sound slightly cliche, but I'm going to run with it. Just how strong are the hands in this market right now, Victoria? I was listening to Amy Wu Silverman of RBC earlier on this morning. She tuned into Bloomberg Radio and she phoned in and she said something like, I would describe people at the moment as fully invested bears. How fragile has the buying actually been?
I think that's a great description of where a lot of investors are. It's where a lot of our clients, I think, feel like they are because we tell them you want to be invested in this market. The pull down that we've seen so far has not changed the trends. The trends are still higher. Until we see the trends change, we see negative relative performance coming out of some of these leadership sectors and staples start to perform a lot better, then I think you continue to see the market, although it will churn, you will continue to see it move higher. And that's why you want to be invested in the market. But there are these warning signals. We haven't been getting the data. We're about to get it. What is it going to tell us? Is it going to say we're weaker than what we thought some of the private data was actually telling us? If so, then yes, you will continue to have some spaces where you want to put some defensive components in your portfolio. So it does make sense. It is fully invested, but a little bit of a bearish outlook.
Victoria, just to build on what John was asking about, it sounds does seem like institutional investors are fully invested, especially if they missed out on the rally earlier this year. It does seem, though, like there is retail selling. And when you take a look at some of the high momentum sides of the market, that's what's led the drawdown. It raises this question. Earlier this year, retail and buying actually led to the upside, and investors chased that. Is this going to be the reverse of that? Retail selling, and then eventually institutions chasing that as well? Or are they stepping in to actually pick this up?
Yeah, unfortunately, I think you do see a lot of the retail investors chasing that market. And like you said, the reverse right now. Institutional investors tend to take a little bit of a longer term approach. And so they are slower to move on some of these changes. They look and say, what are we looking at 3, 6, 9, 12 months out? Retail investors tend to be a little bit more emotional investors. And so you see things change more quickly and more turnover in some of those portfolios. We have said all along, don't chase this market. Let it come to you. There's going to be an opportunity here because of the weakness that we saw in breadth and internally that the market's going to come to you. And that's what it's doing right now. So I would actually take this as an opportunity to add to some of the names that you've liked, some of the sectors that you're starting to see troughs and see uptrends. We've talked about them before. You look at healthcare, you look at the big banks, you look at some of the materials components and the metals that are there, and even energy. We saw about 40% of the S&P energy sector actually make 3-month highs earlier this week. So I think there's some places you can play. Institutional investors will start stepping into that, but retail investors tend to be a little bit more emotional and move with what they're seeing in the headlines.
You didn't mention tech, Victoria, and I do think that we have to focus on that, given the fact that not only has the tone shifted, but there's been a shift in the fundamentals of some of these companies. Not that they're not earning tons of money, but it does seem like the debt issuance of the past few months has really caused some concern. You are seeing bond markets start to push back. You're seeing concessions in some of the new issue market. You are seeing some bonds lose a ton of value, particularly from Oracle. I'm just wondering if this is a warning shot to you that there has been a material shift in the tech sector and greater risk going forward.
It's definitely a warning signal, Lisa. You know, we watch spreads very closely in the bond market. They are a warning signal, that canary in the coal mine to tell you what's happening. And we've seen the widening over the last month and even over the last quarter. Year to date, we're about equal at this point in time. We had been extremely tight. We've seen spreads widen out. And yes, when it comes to tech, you're seeing large issuance come out. And it's been a question for a while. How are a lot of these companies going to pay for what they're saying they're going to do? And how is that going to affect free cash flow? How is that going to affect their debt ratios? And we're seeing some of that come to fruition now. We're seeing some concerns about what that means longer term, especially if we're not getting the revenue generation that a lot of these companies say they're going to. So definitely something to watch and to be careful on when you're looking at the debt market.
These companies, Victoria, seem absolutely determined to spend. They've said that repeatedly. They are determined not to underinvest, and they don't mind taking the risk of over-investing. Do you really see this market in a position at the moment, at least, to inflict discipline on those hyperscalers who are absolutely determined to spend hundreds of billions of dollars on this effort?
Yeah, discipline is an interesting word, Jonathan. I'm not sure that they are. These investors right now look at these companies and they believe what they're telling them. They're saying, okay, even though we saw free cash flow take NVIDIA out of the equation down almost 20% year over year for a lot of these companies, and now we're seeing debt issuance move higher, investors still say they're going to be able to do what they're doing. You heard Lisa Su this week talk about 80% revenues from data centers for the next 3 to 5 years, year over year. That's a lot of positivity coming from these companies, but yet at the same time, we're hearing builders can't deliver on data centers. There's not enough energy and power for some of these data centers. So I would be a little more skeptical than maybe the average investor is. But, you know, I'm a bond girl at heart, so that makes sense that I would be a little more cautious. But I do think for now, they are taking these companies at their word because their earnings are supporting it. The minute we don't see earnings supportive, that's when I think you'll see it all flip.
Victoria, so how are you handling this? Are you selling tech stocks and selling the bonds as well? Are you buying the stocks, selling the credit? How are you playing it?
Yeah, so we're trimming on some of our big tech names, but also we want to stay within, we have parameters within the benchmark of where we need to be on these. And because there's such strong holdings in the benchmark, we can't just eliminate these holdings completely. You have to have exposure to them. But we are taking the opportunity to put it to work in other areas, both on the equity side and on debt. And looking at that debt, like 7 to 10 years out, we're starting to see the yield curve steepen. That 2 to 30 spread was like sub 100, and now we're about 115. So we're starting to steepen a little bit. It's good for financials. That's our main area of where we're looking, but we're also looking at healthcare, buying some bonds and some equity there. And then, like I said, looking at materials a little bit as well. I think those areas on both sides of the equation you can have in your portfolio.
Victoria, thank you. Appreciate your take. As always, Victoria Fernandez, a bond girl, her own words. Victoria Fernandez of Crossmark. If you are a bond person, you'll be looking at this situation and it'll get your radar up, that's for sure.
Well, you took a look yesterday at Oracle's, say, 30-year bonds, and they plummeted. They're 92 cents. They were at 100 cents about a month ago on the dollar. And it raises this question of how much pushback has there actually been? And going forward, will this reduce some of the hopes and dreams of some of the more speculative players? There was another one, Applied Data Technologies, that came out and had to sell bonds at a huge discount in order to get some of the investor appetite up. So, again, you are seeing pushback, and that is a different tone in markets.
I keep going back to that Sam Altman interview. I know I keep going back to this.
I know you do.
I just found it so awkward. Just asked a very direct, simple, reasonable question. Your revenue's here. Your spending commitments are right out there. And they're really, really big. How do you get from here to here? How does one inform and support the other? Just a non-answer. Sell your stock if you want to. I found that really uncomfortable. For a moment we're in, with the valuations we have, that's not the right answer.
Faith-based investing may work for certain asset classes, in particular tied to equity. They do not work for bonds. And that is what you're seeing when it comes to Oracle. Even people are worried about Microsoft and how much they're tied to OpenAI and how much their valuations highlight the losses that OpenAI is expecting to have going to 2030. They're not expecting to turn a profit until then. So again, it highlights exactly what you're talking about. A sort of gap in balance sheet logic.
Losses picking up this morning. We're down by 0.9% on the S&P 500, down lower even more on the Nasdaq 100 so far this morning. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Verizon is discussing plans to announce job cuts that could downsize the company by as much as 20%. The planned cuts could impact up to 20,000 workers and are part of an aggressive strategy to reclaim market share. The Wall Street Journal reporting the company is also planning to convert 200 company-owned stores to franchises. Meanwhile, Minneapolis Fed President Neel Kashkari joins other Fed officials who have expressed skepticism over the need for another cut in December. Kashkari said he didn't support the last interest rate cut. Some Fed officials are arguing for holding rates steady to balance inflation and weaker hiring in the labor market. And Blue Origin launched its New Glenn rocket to space and successfully deployed 2 Mars-bound NASA spacecraft yesterday. The rocket's booster separated from its upper stage, descended back to Earth, and landed on a barge in the Atlantic Ocean after firing engines to slow itself down. The successful mission puts Blue Origin on track to challenge SpaceX's grip on the launch industry. That's your Bloomberg Brief. John?
Yahara, thank you. Very cool. I will always be impressed by that. Thank you. More from Yahara in about 30 minutes' time. Up next on the program, Making America Affordable.
Affordability, they call it, was a con job by the Democrats. My administration and our partners in Congress will continue our work to lower the cost of living, grow our economy, and make America affordable again.
Up next, Sarah Bianchi of Evercore, live from New York City this morning. Good morning. Session lows right now. We're down by 0.9% on the S&P 500, down by more than that on the Nasdaq 100, negative by 1.3. A snapshot of some of the tech players in the pre-market. Nvidia not having a good morning, down by about 3%. Palantir down by something like 4. Lisa, these losses are building.
Yeah, and we're building more aggressively, and some of them more speculative and highly levered to the AI trade. As you go and you see some of the ones that are the most speculative in terms of how much they're borrowing and how much they plan to invest in the future, this is the pushback that people have been talking about. So now the question is, how much is this just simply vibes, and how much is this real with respect to a changing structure of the entire tech stack, given the fact that their hopes and dreams have a price tag?
It's fair to say this morning the vibes aren't good as the losses pick up, just teasing out a bond market rally, just a little bit of one. At the front end of the curve, we're down by 2 basis points on 2s. On 10s, now down by 2 to about 410.18. That's a fresh development in the last 20 minutes or so.
Yeah, right now people still looking for a haven and some kind of income. This is the conundrum. How much can U.S. government bonds continue to provide a haven, given the fact that 30-year bonds still are priced at giving you a 4.7% yield? So some people might say, well, clip your coupon and be happy.
The 10-year and 30-year yield just falling just at the moment, coming back in off the back of those losses in the equity market. Under surveillance this morning, making America affordable.
Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. You people don't want to report it. My administration and our partners in Congress will continue our work to lower the cost of living, restore public safety, grow our economy, and make America affordable again.
So here's the latest this morning. President Donald Trump pivoting to affordability after boasting about his administration's economic accomplishments. The White House now making a push for a tariff deal, announcing new deals with countries in Latin America and potentially elsewhere. Bloomberg's Mika Solna joins us now for more. Mika, welcome to the program. Welcome back, I should say. Can you describe the agreements that have been struck over the last day or so?
Yeah, absolutely. I mean, the White House is really looking to push new tariff deals in order to collect some of the revenue that they think is going to basically explode from their deals from all around the world. And with that, they are pitching the idea of sending $2,000 dividend checks to Americans. That's very much in line with the idea to distract from cost of living, give people hope, while Democrats continue to hammer the message of, quote unquote, affordability to people.
Mika, we're talking about coffee and food stuff coming from places like Brazil, Colombia, Vietnam. Have we heard from the administration about how much they're willing to do to bring tariffs down on some of those goods?
You know, the White House has been very guarded on this issue, and I think that they're still hammering out the details. But I do know that one thing that they're really trying to do is ensure that looking at the long-term effects of tariffs rather than potentially the short-term economic pain that Americans might feel when it comes to the uptick of cost of living. But I know that they're looking for solutions long-term and saying that this is overall going to be better for the country. So that's the message we're hearing right now, with details still hammering out.
Look for the details into the weekend. Mika, thank you. Mika Solna down in Washington, D.C. Let's build on the conversation. Sarah Bianchi of Evercore writing this. A White House pivot back to the issue of affordability won't be perfectly disciplined or linear, and some things will run counter as tariffs remain a favourite policy tool. Sarah joins us now for more. Sarah, Lisa and I were talking about the messaging of all of this. How do you massage the message of all of this? That you talk about affordability and the first thing you consider is to bring down tariffs, which you also simultaneously don't believe push up costs.
Well, it's complicated. Look, this is complicated. President Biden had some of the same challenges. It's just really hard to reduce costs in a lot of ways. But obviously, this administration has a tool that he didn't have, which is to bring down some of their own tariffs. I do think the deals with some of the Latin American countries give you a signal of somewhere where they're going. They did put, not to get too wonky, but Annex 3, a list of food goods that were supposed to be eligible to be tariff-free for countries that had a final trade arrangement with the administration. Obviously, they're just kind of lowering the standards of who gets that deal and really trying to put some relief in the food space. Again, an area where a lot of Americans notice when things aren't as cheap as they want.
Sarah, a lot of the rhetoric seems to push back against a number of the policy prescriptions that we heard from President Trump earlier this year. And I just wonder, it sounds like you're skeptical that this truly is a wholesale pivot point. Nonetheless, how much are you looking for different types of policies, whether it's reducing some of the tariffs or potentially a $2,000 check at the beginning of next year? How much are you expecting these types of policy prescriptions in the face of midterm elections?
Oh, I think it's very serious. I think he's very serious about a rebate check. I think, we saw at first Secretary Bessent push back pretty hard on the concept on Sunday. And since then, he's kind of softened his tone a little bit. I think it's very much a space where they will look. They're going to have to, size it, get it through the Congress and reconciliation, a lot of steps to happen. And then, try to figure out, are they really going to spend all, particularly in the wake of what might be an unhelpful court case on tariffs. But I think on the tariff rates themselves, I think they're going to find places for relief, like we're seeing in food. I don't expect them to say, oh, forget it, sorry about the steel tariffs, we didn't mean to do that, or something like that. I think they're going to look for relief valves in particularly sensitive areas.
Just to underscore the point, how much was an inflection point with the elections that we just saw, the sort of midterm elections that did point to pretty big Democratic wins? How much does this really mark a change in the president's policies going forward?
I think it was very real. It's not that these first year after elections they were blue states, et cetera, but the scope and the size of the win and the voters who Trump just won 12 months ago in, New Jersey was an undercovered story in how close it was in 2024. So these voters coming back clearly and so central, even at a time when the Democratic Party is having its own historic set of challenges, still voters were willing to vote for these candidates. So I think you've watched the president kind of, all over the place a little bit rhetorically, saying it's fake news, but also exploring, a lot of ideas. I think it's a very big pivot moment for the White House.
So there are a number of different inputs to CPI, and one of them, and has been a good contributor to the disinflation that we've seen, has been energy prices. How much do you expect some of the policies around the data center build out in the United States to start shifting or potentially encourage deregulation of the energy sector even further in order to cushion some of the price increases that we're seeing in certain areas that are closer in proximity to data centers?
It's a huge issue. The president, you're right, has always been focused on low energy costs, but he's always really been about gas and oil. And this is a different issue. This is electricity. And it's a very hard issue to get at. It's largely state regulated. FERC does have some oversight, but it's going to have to be sorted with the states. And there are ways to solve it. We've seen places where, some of these data center builders have pretty deep pockets, and so they can actually help fund rather than passing on costs. But we saw this as an issue in Virginia. We saw it in New Jersey, and I expect you're going to see it even more around the country. For the president, it's a little bit challenging because the policy tools are a bit more long dated, but and they do come, part of the solutions or one of the pieces is more wind and solar, never a favorite topic of his, but I expect they'll pivot in this space as well.
Sarah, thank you. Sarah Bianchi of Evercore. That's a lot of pivots. With these kind of things, you can see into the future, and you can already see that we're already behind. You can see into the future because there is a duration mismatch. You can dig a hole and build the building very, very quickly to get the energy that supports it. You need to have built that a long time ago, or at least started to build it. We're already behind.
Yeah, which really goes to the question of who's going to bear the brunt of this. We are seeing certain sectors, certain regions in the United States where people are paying higher costs for electricity. Will some of the hyperscalers be forced to bear the brunt of this and actually pick up the bill? And that point that Sarah Bianchi made, I think, is a really important one.
We can, of course, change the future. There's a lot of work to do. Let's put it that way. Up next on the programme, Alejandra Grindal of Ned Davis Research as Verizon weighs up to 20,000 job cuts. That's next. Stocks are down across the board. We're negative by 0.8% on the S&P. On the Nasdaq 100, we're down by 1.3. The losses are building up. It includes the small caps, the Russell, down by 0.88%. So a risk-off posture so far this morning, now backed up by developments in the bond market. Yields starting to fall across the curve. 2s out to 30s, 2s, 10s, 30s, now down by about 4 basis points at the front end and on the 10-year as well. Let's call this a break of 4.1%. in about the last 10 minutes.
Yeah, and you could say that this is just showing how much the risk aversion is broadening and the knee-jerk response to buy bonds is prevalent. At the same time, The Verizon news that you cited earlier, to me, highlights how much we see a disinflationary tilt from some of the efficiencies from companies. They'd rather cut jobs than try to raise prices substantially and lose customers. That is a Fed story, and that is a bond story.
So that takes the temperature of the US story and maybe the global backdrop for risk this morning. Let's take the temperature of the UK right now. We've talked about the price of chaos, volatility. This market's been wild so far today. Yields are up on a 10-year gilt by 9 basis points. We're up by double digits at 1 point. Sterling. You want the range on sterling today? The low, 131. The high, 132. This morning, 131.52, somewhere in between.
Honestly, this is such a tricky story because at what point will the UK have to raise taxes as gilt yields go up? Essentially, the higher yields go, the more they're going to have to try to plug the gap that they have imposed on themselves with certain fiscal caps. So it raises this question. And Geeta Gopinath, formerly of the IMF, currently of Harvard, I keep going back to this op-ed she wrote in the Financial Times where she said, this fiscal instability has created a crisis of its own making. The fact that investors don't understand the fiscal response mechanism to any kind of increase in bond yields. It just creates this real cycle of doom, and that seems to be what's taking place in the UK.
Really, really bad communication. The marketing from this Labour government has been absolutely abysmal. Every step of the way, it's just scaring people. When they came in, first of all, and said there's this massive black hole, and then they started spending loads of money on public sector pay rises, and then had to increase taxes aggressively, and then said, we won't do that again. And we've spent the whole summer. Think about the message you're sending to the British consumer over the summer. We spent the whole summer coming right into the fall telling people that this tax might go up, that tax might go up. Oh, if you're super wealthy, there might be an exit tax. That tax is going to go up. This tax is going to go up. What are you going to do in between? I've got a good idea. I'm going to invest lots of money in the British economy. I'm going to make a 5-year, 10-year, 15, 20-year trade on the UK right now. Who, in their right mind, would make that kind of decision if this is your backdrop for taking risk in the UK?
No, what they're doing is they're buying real estate in other countries, and that's actually what's happening in a broader specter. At the same time, the fact that they're benchmarking a lot of their projections to the market and to bond yields and how much that increases their fiscal gap highlights how much they are in this sort of cycle where they have to plug a gap at some point because they're going to have to raise taxes to pay for the bond yields that are going up in respect to their fiscal discussion.
Sterling right now, 131.53. We're down by about a third of 1%. As we count you down to the opening bell about 2 hours away, let's get you some morning movers with Yahira. Hey, Yahira.
Hi, John. We start with Warner Brothers Discovery. Shares are rising 2.8% on growing conviction a buyout is coming. That's because the Wall Street Journal is reporting that Paramount, Skydance, Comcast, and Netflix are all preparing bids ahead of a November 20th deadline. Meanwhile, here are the stocks getting hit this morning, the tech stocks getting hit this morning as markets remain on edge. Tesla, Nvidia, and Alphabet are the biggest decliners among the Mag 7. This is coming as hopes fader for a December rate cut. And without that, it's tough to justify these tech stocks' high valuations. But Nvidia could report spectacular results this next week, and then we're off to the races once again. And we end on some M&A action. We are seeing Cidara Therapeutics shares rising 100%. Merck is buying the company in a $9.2 billion deal. And we've seen a lot of deals like this in the pharma space as these companies look to refill their pipelines. For Merck, the issue is that its blockbuster key cancer drug, Keytruda, will soon face competition from generics. So it was willing to pay up for Cidara, paying double what it closed at yesterday. That's what you're seeing, shares up more than 100%. John?
Yahara, thank you. Massive move. Absolutely massive move. Appreciate it. Thank you very much. On our radar this morning, our top story, the White House unveiling framework agreements with Argentina, Guatemala, El Salvador and Ecuador to reduce tariffs on common grocery items. The trade deals will see tariff reductions on beef, bananas and on coffee beans. Elsewhere, Paramount, Comcast and Netflix preparing bids for Warner Brothers Discovery. The Wall Street Journal reporting the deadline to submit non-binding bids is November 20th. Warner Brothers hoping to complete the auction process by the end of the year. And finally, Oracle taking a hit in the recent sell-off as fears grow over its mounting AI debt. The software giant shares are down nearly 30% over the past month, the slide reversing more than $250 billion in gains since disclosing deals with OpenAI in September.
Let's talk about the debt. So right now, Oracle has about $96 billion of long-term debt. That is up from $75 billion a year ago. Morgan Stanley predicts that this amount of debt will go to $290 billion by 2028, right? So that's 3 years away that we could see that kind of tripling in their overall debt load. What is it going toward? That is the key question. How much are they hinged to OpenAI on the story that has been deeply unsatisfying for people? That, yes, they're not going to turn a profit to 2030, but they expect to spend hundreds of billions of dollars in some of the outgrowth of data centers. This is the difficulty, and Oracle is almost the leveraged play on how much people have a sentiment for OpenAI and how much tolerance they have to really issuing a lot of debt.
So I've seen the same moves, and I was thinking, is this code red? So I reached out to Robert Schiffman of Bloomberg Intelligence, who covers the credit story. You know him well, fantastic guy. He said, yes, we've seen a massive move in CDS, but he thinks it's more about technicals on hedging all this new debt versus fundamental concerns that credit is going to junk. So I said to him, keep me in check. When we get to code red, let me know. He doesn't think we're there just yet.
Well, certainly not code red. But certainly maybe a little bit of the sheen has come off the bloom.
Absolutely.
The bloom has come off the rose. There is a feeling right now. I mean, if you take a look at the Oracle debt long term, it's been affected by the fact that duration has sold off. So it's not just a question of the credit worthiness. Nonetheless, there is more skepticism. And I keep going back to Applied Digital, which is a high yield rated company that tried to come to market yesterday with some notes, with some bonds, and they had to offer a 10% yield in order to sell it. They provide some of the data center products to CoreWeave, also a high yield rated company that provides some of their services to OpenAI. You start looking at how circular this becomes, and you start wondering at what point are we going to see a lot of weak players? And that, I think, is what the market's trying to suss out.
There's some pushback, Lisa. I'm totally there with you in the credit market, and it's spilling over to equity as well. Equity futures down this morning by about 1% on the S&P 500. Let's turn to the labour market. Verizon discussing plans to cut about 20% of its workforce, potentially impacting up to 20,000 workers. People familiar with the matter telling Bloomberg cuts could come at every level of the business. Alejandra Grindal of Ned Davis Research joins us now for more. Alejandra, welcome to the program. Let's get into some of this. So I see these big flashy headlines from the likes of Verizon. It looks awful. And then I see the state level jobless claims, and they look okay. What's the state of the labour market from your vantage point?
Oh, thanks for having me again. So, obviously we're not getting the non-farm payrolls data, so we're not getting the clear number that we're used to, but we're able to sort of cobble together a lot of data, including layoffs. I know the Challenger layoff announcement really freaked a lot of people out because it was an unusually high number. But on balance, when we sort of put the numbers together for the month of October, we're looking at very modest gains in payrolls. So not quite as dire as the numbers some of these headlines suggest, but very much in line with what we'd been seeing in the prior months, that we're just not seeing the job creation that we had before.
There is a problem going forward, at least briefly, Alejandra. Going forward, when we get the economic data, we won't get unemployment, we will get payrolls. And payrolls has been the concerning thing. And if you can take some comfort from anything in the labour market, it's still a relatively low unemployment rate. How will you digest the incoming data in the next few weeks with that in mind?
Just overall that there's going to be some data missing?
Yeah.
Well, at least, and I think I mentioned this last time I spoke to you guys, is we haven't been completely in the dark. Within the United States, there's still a fair share of private sector data, Fed data that we've been able to work with. I think we're going to look at that number. But when you compare it to other data that we've been getting in recent months, I think we're still not getting that bad of a picture. And as I mentioned before, I think it's consistent with, maybe not this enormous decline of the labor market, but definitely weakness that I think still, pushes the Fed to maybe consider cutting in December.
How much does the weakness that we've seen in the labor market encourage you to downplay any kind of inflationary risk? And I'm pointing to the likes of Verizon, the idea that why are they cutting people? They are cutting people so they can compete on price, so that they can lower prices or keep them steady for consumers, because they are losing consumers because of price. How much is this a theme versus an idiosyncratic incident?
Well, there's a broad array of risks to look at that the Fed has to deal with, obviously inflation being one of them. But with respect to the economy, I mentioned, obviously, they started cutting because they started cutting rates to begin with because the job market's not as strong as it was before. And we're still seeing signs of that with this other data we've been able to put together. I think another key takeaway, too, is Main Street is hurting. So even though we can often look at financial conditions and they look okay, Main Street, the average American, just isn't doing as well. And they're very sensitive to Fed interest rates. They're sensitive to mortgage rates. They're sensitive to housing prices, credit conditions. We're seeing delinquency rates rise. So that's sort of that underlying issue that the Fed has to address. In terms of the inflation story, I mean, yes, we do expect inflation to stay at least above what the Fed's target is anticipating, say over the next 6 months at least. Some of it obviously reflects the tariff side of things, some of the deportations, but long-term inflation expectations remain anchored. And I think it's also really important to keep in mind that the Fed funds rate is still, contractionary, right? So it's still above neutral. So I still think there's some room for the Fed to cut policy and, so sort of help that Main Street, help that labor market get in a better position over the next few months.
Over the past few days, we've seen a bit of a wobble in the tech sector. And this has been the sector of support for the overall economy and for GDP more broadly. And I just wonder how difficult it would be for this economy to keep expanding if you see this wobble continue to expand, both on stock prices, but also on some of the dynamism expected from these names.
Oh, absolutely. I mean, that's really what's holding us, right? So the consumer on aggregate continues to spend, but this is the higher end consumer. The higher end consumer is tied to the stock market. Stock market has been doing well, obviously not the past couple of days, but has been doing well because of the tech sector. So there's definitely this feedback loop. And I would even, using a technical term within the economy, very weak breath. So it makes you vulnerable to a potential downside. On the other hand, there still could be a lot of huge benefits from artificial intelligence and technology. We're seeing it ourselves in our firm. And especially as not just the United States, but other developed markets are sort of facing this future of a waning labor force. We need this productivity, which could be boosted by AI, to ultimately increase our growth potential at the end of the day. So, there's definitely an upside coming from it. And as I said, I think we're seeing it. A lot of other people are seeing it as well, but it does make the market and households very, very vulnerable if things were to tip over.
It's making them nervous already. Alejandra Grindal of Ned Davis Research. Alejandra, thank you. It's good to see you, as always. It's making people very nervous. I keep going back to that line from Luke Hauer. Luke making the point that it's regressive up front. And that's the problem right now for consumers, for Americans, and of course for the politicians who are going to have to really wrestle with this going into next year.
Yeah, and as long as there is patience in the investing world where people are willing to finance it, both in the equity side of things as well as the debt side of things, then the regressiveness of it can be masked by high valuations and some of the dynamism in the build out. If that softens, how much is that going to be a painful year or two in order to right-size the economy to some of the technological promise?
It's softening this morning. The Nasdaq's down by 1.6%. The S&P lower by more than 1 percentage point. With an update on stories worldwide, with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. The BBC has apologized to President Trump for the way it edited his January 6, 2021 speech for a documentary after the president's lawyers called it defamatory. The news organization said it strongly disagrees there is a basis for a defamation claim. The Trump team has threatened a $1 billion lawsuit. Meanwhile, unionized Starbucks baristas launched a wave of walkouts yesterday. The strike, involving more than 1,000 baristas at 65 cafes, was tied to Starbucks' annual Red Cup Day promotion and is the latest escalation in the union's efforts to ramp up pressure on the coffee chain. The union accuses Starbucks of refusing to fairly negotiate, while Starbucks has denied wrongdoing. And Apple unveiled its new digital ID system, which allows users to add a copy of their passport on their device. Travelers can scan their Apple Wallet at airport readers and use the copy if they don't have a real ID. The company warned that this does not replace a physical passport and can't be used for international travel or crossing borders. That's your Bloomberg brief. John.
Yahira, thank you. That's quite cool. That's a big win for Apple, that is, on the security front.
Oh, I would completely agree. I mean, how nice is it? Think about waiting on the line and you have a phone in your hand because you're looking at news.
And it's always in your hand.
It's always in your hand.
Too big to put anywhere else.
Exactly. So you're looking at your phone and all of a sudden you get up to the counter and you have to take out your bag and you have to pull out your ID. You've got to hand it to them. This way you could just say, boop, and then you could keep just getting addicted to your phone.
How long before we do that on the international front?
I don't know. That's a tricky thing.
Hopefully we get there soon on that front too. Up next on the programme, negotiating new deals.
We're seeing new corridors opening up. And the scale of ambitions, not just in China, are higher than we see really in many other parts of the world.
They want you to have like 20 pages so they can stamp them all, you know?
on the inbound and the outbound. Why did the outbound? What is this?
It's
The passport
ridiculous.
control? I don't understand.
Why do you care so much about who's leaving?
Why do you want to keep in the criminals? I don't get it.
Let them go.
Exactly.
Someone else's problem.
100%. I don't get it.
Yeah. I'm right there with you. It's tighter on the way out sometimes than it is on the way in.
It's worse, 100%. And it's sort of like, what is this, job security?
Experienced that in Italy. This was a good rant. Enjoyed that. All right. Up next, the former senior White House trade advisor Kellyanne Shaw joins us in just a moment from a beautiful New York City. You're watching Bloomberg TV. Stuart Kaiser City pointing this out, just published, saying flash flood of poor news in the last 24 hours is dragging this equity market down. We're down by 1% on the S&P. On the Nasdaq, we're down by 1.5. I have to say, to take a step back from some of this, the poor news is just that the market's moved lower. And it seems to be price shaping the narrative, because I can't really point to one single thing that says, you know what, that's the reason this equity market was down hard yesterday and down again this morning.
Is it a vibes issue? Is this something where people are suddenly just concerned about the debt outgrowth of some of the tech names, and that's sort of leading everything into a spiral, in addition to job cuts and in addition to some softer than expected economic news? I don't know. That's really to be seen. Can this market tolerate a couple of high-profile blow-ups? That is what I want to know, if there are weaker hands that do ultimately suffer real pain.
It took a while for this bond market to start rallying. You're starting to see it now at the front end of the curve and through the belly. On 5s, we're down about 5 basis points. On 10s, we're down about 4. Down 4 basis points also at the front end of the curve at 3.55. Look, the one thing holding up the aggregate numbers in the economy right now is the high-income consumer. And based on a sentiment survey, the only reason the high-income consumer is happy right now is because of the equity market. So to some extent, the stock market move will shape perceptions of what the Fed might do in the coming months.
This economy is profoundly leveraged the AI bet and the optimism that it's fueled both in equity markets and beyond.
The equity market story pulling lower by about 1% on the S&P, and the bond market yields down by 4 basis points. Under surveillance this morning, negotiating new deals.
We're seeing new corridors opening up. And the scale of ambitions, not just in China, are higher than we see really in many other parts of the world. I think the recent truce has brought some much needed and welcome stability. We're in a position now for both sides that wanted to have a period now where we can move ahead.
So here's the latest this morning. Wall Street watching for fresh trade deals from the White House. The Trump administration announcing new framework agreements with Latin American countries as talks continue with China. The former White House senior trade advisor Kellyanne Shaw writing, one thing is clear, despite the shutdown, USTR has been extremely busy negotiating. Kellyanne joins us now for more. Kellyanne, welcome back. We've been tracking this together since it started back in early April. In fact, since the election took place more than 12 months ago. Are you seeing this administration and White House start to change course a little bit?
Yeah, good morning. Thanks so much for having me back on. I see directionally the White House continuing the strategy that it started with, which is we are going to impose these very high tariff rates and then negotiate with trading partners to try to land them at a place that's a bit more reasonable. And so they're continuing to do so, notwithstanding the White House's concern, which is clearly focused on the issue of affordability, consumer confidence, how much you're paying at the grocery store. Now, on top of this, on top of those 4 deals that were announced, plus we had South Korea, that framework which was released last night, a potential upcoming deal with Switzerland, an interim deal potentially with Brazil. You're seeing the White House tease a more significant tariff relief package, which would really hit Americans at the grocery store. Now, this would be a departure from where they've been going, but I do think directionally all along, they've anticipated that they would need to course correct, that there would be recalibrations where there had been overcorrection. So I think we're starting to see the first part of this.
There's some contradictory messaging here. You're well aware of that. On the one hand, you're saying that tariffs don't lead to higher prices. On the other hand, you're saying we need to do more on affordability. We're going to drop tariffs. How do you massage the messaging?
Yeah, there was always a little bit of dissonance between these two messages. And this was always the White House's case to make to the American people, that if we impose an average 15 to 20% tariff on all goods coming from all countries, that's not going to lead to higher prices at the grocery store. It's not going to make your vacations more expensive. I think the American people have always been a little bit skeptical of this argument. And this is something the White House is going to have to continue to message moving forward. Now, that said, what they'll point to to is the fact that we imposed hundreds of billions of dollars of tariffs in Trump 1.0, and that did not lead to inflation. And if you look at countries like India or South Korea, which naturally have very high tariff rates, they're not concerned about that leading to inflation on a day-to-day basis. So why would that pattern hold in the United States? But I do think voters are not quite there yet, and this is something the White House is going to have to navigate.
Kellyanne, how much is this argument a liability for the White House when it comes to the Supreme Court case? The idea that they're arguing that this is a national security issue while also talking about reducing tariffs for cost of living concerns.
Well, I think we've got a bunch of different types of tariffs, some of which are being challenged right now at the Supreme Court, others which aren't. And we've always had carve-outs since the beginning of certain product categories like your iPhone, your laptops, some of the pharmaceutical products and aircraft and airplane parts have always had different tariff treatment. So shifting some of that around or targeting certain food products, I don't really think is going to make that much of a difference in terms of how the Supreme Court is looking at this.
Do you think, though, that, Kellyanne, when you talk to some of your clients, there is a feeling that maybe we've seen the peak in terms of the tit-for-tat trade war type of behavior, just simply because the cost of living concerns are starting to trump the concern about national security and the concern about getting leverage internationally?
Well, I think regardless of how voters are viewing cost of living, that we effectively had reached sort of the peak of this trade war to begin with. The president was always going to come out swinging at the beginning to make this huge move to try to negotiate with every country on earth and then land the plane at a lower rate. And that's what we saw him do in August. I think we're beginning to see more and more tariff reductions as part of these deals being negotiated. But I wasn't expecting these like huge swings moving forward. I think this is effectively where the president wants to land things and have the tariff rate be on average at the end of his 4 years. Now, I do think that consumer confidence and affordability is a significant issue for the White House, which is why you're seeing them take this head on, as opposed to the prior messaging, which was more about, don't worry, the economy's doing great, kind of ignore how you feel. They're not there now. They're head on addressing this. And I think that these recalibrations on tariffs are a reflection of that.
Kellyanne, thanks for joining us. Kellyanne Shaw there, the former senior White House trade advisor. Going through some of the previous tariff relief, I always felt that the relief for Apple, the carve-out, was for Apple. And that some of the relief we've seen over the last year or so, a lot of the relief, if any, has been for Wall Street. This is a change. This is relief directed right at Main Street. And that's the change that I think you've got to track going into next year in the midterms.
Especially because it's a complicated thing to do. This is not as easy as just saying, okay, we'll reduce the tariffs and then prices go down. This is an issue of an entire ecosystem that needs to get back into some sort of order. And there are price increases that are not tied to tariffs. So if things start to get tied to tariffs that are not necessarily sensitive to that, you have lost control over both the message as well as some of the inflation. So this is going to be a much more difficult thing to nuance than, say, a carve out for Apple or questions around NVIDIA's chips.
We've got to keep tracking this equity market as well. The Nasdaq 100's down by 1.5%, just off session lows. On the S&P 500, we're negative by 0.9%. Coming up, we'll catch up with Darrell Cronk of Wells Fargo, Jay Goldberg of Seaport, Michelle Meyer of Mastercard, and Mona Mahajan of Edward Jones.
The volatility and the rotation that we're seeing among single names is healthy.
The breadth picture under the surface for the S&P 500 is actually starting to improve.
The Mag 7, they just have to sort of behave, right, in order for the market not to have, kind of one of these major scares.
I think equities are still going up 15 to 20% from where they are over the next year.
This bull market deserves the benefit of the doubt.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This stock market is not behaving. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures down across the board. On the S&P, down by almost 1%. On the Nasdaq 100, we're down by 1.4%. The Russell, negative by more than 1%. In the bond market, 2s, 10s, 30s. Yields down across the board. We're down by 4 on 10s, down by 3 on 2s. I, like many, made the observation earlier on in the session that we weren't getting the bond market offset to the equity market drawdown. That changed about an hour ago.
Yeah, as the risk aversion in stocks started to grow, you saw people who start to revert back to that long-term bond bet with this idea that maybe we would ultimately get a slowdown in the overall economy that would lead to lower bond yields. Look, right now, this is notable. It does feel a little bit different, even though it's not that big of a drawdown. You can't exactly say this is a correction. We just saw the worst day for the NASDAQ and the S&P going back to October 10th. You see more selling, and it is not just in the stock market. It is also in the credit markets, which until now have been rock solid.
Tracking the latest from Cameron Kreis this morning, this is what he wrote in the last 30 minutes or so. Some 135K of 10-year contracts traded in a 10-minute window, 10-minute span, a little bit earlier this morning in the last hour, the largest volume cluster of the week. He didn't see any particular catalyst, neither did I, but evidently, in his words, somebody came in and said, mine.
Yeah, and I just keep going back to what Bob Michael said of JP Morgan Asset Management. There's so much cash. All you have to do is have a little bit of yield and people will flood into it. And that seems to be what we saw earlier this morning.
Looking ahead to next week, lots of earnings on deck. On the calendar, we'll see some retailers, Home Depot, Target, Walmart, the tech monster, the giant Nvidia. They get earnings on Wednesday, so look out for that. This morning, we're talking about Verizon. Let's talk about that company. The message coming from Verizon, the way you framed it, Lisa, I think you framed it so well so far this morning. The message coming from Verizon is buy bonds. Ultimately, there's going to be damage to the job market and we can't pass on higher costs.
This is a company that has 100,000 employees. They're talking about potentially cutting about 20% or 20,000 employees. And it comes after losing market share, after seeing some of their customers defect to the likes of T-Mobile or AT&T because there were lower prices there. How are they going to compete? They are going to compete on price. How are they going to do that? They're going to become more efficient. How much is this a Verizon story and how much is this an economic story?
I mentioned some numbers next week, of course, Walmart in the mix next week on Thursday. This just crossed in. There's a headline for you, Bramo. New leadership at Walmart.
This is actually really surprising. Walmart CEO Doug McMillon is planning to retire. Walmart, the company, just named John Furner the new chief executive officer, and this comes at a time of a lot of transformation at Walmart. Walmart has gone from catering to the low-end consumer, the box stores that everyone has relied on, to increasingly e-commerce, catering to a higher-end consumer, and really deploying tech in a mass way. This is a fascinating shift. I'm really curious to see exactly what was behind it.
He will retire from his position as president and CEO, effective on the close of business on January 31, 2026, on February 1st, 2026. Mr. McMillon will continue in his capacity as an executive officer of the company. He will report to the chairman of the board of directors, and he will continue to be employed as an associate of the company through January 31, 2027.
This is fascinating. Again, we have to just emphasize Walmart is one of the biggest employers, if not the biggest employer, private employer in the United States. They are the biggest retailer in the United States. They are setting contracts and prices across the world, frankly. They have been a real question mark when it comes to what is their strategy going to be, what is their read-through in the economy. And at this moment, to be having new leadership, again, this is really interesting. I'm very curious to hear more color as it comes out.
Walmart this morning down by about 2.5% in the pre-market. Ahead of earnings next week, some leadership changes at the top of that company. Coming up this hour, Darrell Cronk of Wells Fargo joins us as stocks hit a tech-fueled sell-off. Jay Goldberg of Seaport seeing signs of an AI bubble. And Michelle Meyer of the Mastercard Economics Institute as consumer spending outpaces sentiment. We begin this hour with equities pulling back as traders digest hawkish signals from the Federal Reserve. Darrell Cronk of Wells Fargo highlighting the three I's that matter: inflation, interest rates, and illiquidity. Writing the recent sell-off is more about positioning and sentiment extremes and weak hands than a change to underlying fundamentals. Darrell joins us now for more. Darrell, good morning.
Good morning, John.
Just build on that a little bit.
Okay.
The fundamentals are strong, are they?
The fundamentals are still strong. I don't think that there's a lot of debate about that. What I would say, the two things maybe in yesterday's sell-off that people missed, right? Number one, you had all the Fed speakers out being hawkish, right? So for a moment in time, Fed funds futures for a December cut dipped below 50%, right? The prior day, just to put that in reference, they were at 69%. A month prior to that, they were 95%, right? So that's a pretty big move. That's the spark that lit this thing yesterday afternoon that we started the sell-off, right? What I found was interesting yesterday was, obviously decent breadth on the equity sell-off. But if you looked at yesterday, treasuries were negative, Bitcoin was negative, gold was negative, the dollar was negative, right, which is everything. So going back to the point about weak hands and stuff, when positioning and sentiment gets out over their skis or offsides, and people have to cover margin calls and other things. You sell what you can, not what you want, right? And so you're forced to sell strong assets, treasuries, right? Gold, things that you would normally hang on to meet some of those extremes in markets. So I think that's what you saw yesterday.
Everything that's done well in the last year or so, year to date, did poorly yesterday. Got that. The equity market, is that a stronger story to get hold of? When you look at the equity market right now and people are talking about 5 to 10% pullbacks, is that a pullback people ultimately want to buy or a pullback people run away from?
So we have a lot of conviction around this. We've been, like a lot of people, waiting for that kind of intra-bull equity correction. 5, 10%, you usually get 2 a year, 10%, 1 a year in a calendar year. We think this is absolutely viable, right? We like the fundamentals going out into 2026. So if you get a 5, 7, 10% pullback, I would be using it as an opportunistic way to add capital in. Now, what we did do is we downgraded technology on October 30th from favorable back to neutral. Neutral still a sizable weighting, obviously, in a portfolio. Ironically, the NASDAQ hit its high on October 29th. So sometimes it's better to be lucky than good, right, on those type of things. But where we would put capital is in places like financials, industrials, utilities, places where you're getting some of the benefit of the horizontal expansion of AI without having to buy the valuations of the tech.
Okay, I love this. You're the second person this morning who said, yes, buy the dip, not in tech, but in everything else. Buy the dip in financials, buy the dip in healthcare. At what point are we hearing an increasing aversion to buying tech at these valuations, even in a 5 to 10% drawdown, just simply because the structure of some of these companies has changed?
Yeah, I think it's a good point, Lisa. I mean, the point I made about being neutral, right, with the market cap weightings of the index, you still have to have a meaningful position, obviously, in technology. But let's just admit, like, things got out a little bit over their skis here. They got a little white hot. We saw the same thing happen in mid-October. Remember, the catalyst at that point was when President Trump came out and said he was going to put 100% tariffs on China and that he and Xi weren't going to meet. And all of a sudden, the VIX spikes to 28, right? This morning, we're at 22, right? So that kind of what I'd call sticky volatility that's been with us for the last 30 to 45 days, I think is emblematic of what's happening as we transition in this tech world. To us, just valuations just got to extremes through the summer months and the early fall, and we just said, time to take some profit, right? Pull that back. I don't think you abandon tech by any means, but we find better risk-reward trade-off in places like financials, industrials, and utilities.
Does the move that we're seeing this morning in bonds in particular make you like treasuries once again as a hedge? And I'm talking about long-term treasuries.
Yes. I mean, I think you can still buy treasuries here. What people forget is if you look at the Bloomberg, U.S. Bond aggregate, it's up 7.5% year to date, right? I mean, we haven't had positive bond returns for probably 4 years post-pandemic, right? It's finally accretive again to portfolios, right? And so I think you can still use those bonds as a traditional way to play that sector, right? What people also forget is U.S. households own $61 trillion worth of U.S. equities, right? So if you do get that 10% correction, it's meaningful. In fact, if you do the math, it means probably about 0.75% to 1% of GDP that it can shave off if you get a 10% correction, or vice versa, can be additive. So part of the economic growth story has just been the wealth effect of what's happening if you just simply do the math.
How supportive is tariff revenue for this bond market? And if it started to go away, or was spent elsewhere, what would it mean for the Treasury market?
It would put upward pressure, no doubt, on Treasury yields, particularly the long side of the
developing?
curve.
Is that happening right now?
Maybe not quite yet. I mean, obviously concerns about IEEPA, but to me, John, the tariff story is not about whether tariffs will be applied; it's how they'll be applied, right? Because if they're not done by IEEPA, they'll be done by Section 122, Section 301, Section 232. It'll take longer to do it.
They'll keep raising the money, right?
They'll keep raising the money.
And are they going to keep spending it too? Because we've heard about $2,000 rebate checks this week, and it doesn't feel like that story's losing steam.
Yeah, if you take what they've raised already and just projected tariffs and freeze them at this moment, it's about $410 billion, right? That's almost 20 to 25% of the $1.8 trillion budget deficit, right? So it's meaningful to apply back, against that if you can do it. If for some reason you're going to refund all that money back to whence it came, guess what happens to corporate margins and earnings, right? Because all that money was pulled in. If it goes back to the companies where it came from, all of a sudden it's a monumental lift in margins and earnings.
These are all potential negatives for the bond market, potentially
Correct.
for the Treasury market. The credit market supporting massive AI spend now as well. So the bigger question, I think, across Treasuries and credit, will Treasuries and credit continue to support the big dreams of the equity market, given how it's priced at the moment going into a new year?
So let me put it this way. Our year-end 2026 target for interest rates on the 10-year and the 30-year are in the 4.25 to 4.50 kind of range, right? So higher from today's levels, right? Probably the highest conviction that we have in the Treasury markets right now is the curve steepener. We still think no matter how you play it, the curve has to steepen, whether that's short-term rates coming down and long-term rates staying somewhat stable, or long-term rates going up, which is your story, right, about concerns about fiscal, concerns about tariff.
Someone has this story. I'm just articulating it for them, of course. Darrell, carry on, please.
No, that's right. I mean, but I think the right normal level for long-term Treasury yields, right, are in that 4.25 to 4.50. Remember, the long side of the Treasury curve is a term premium, a growth premium, and an inflation premium, right? And growth premiums and inflation premiums have been coming down. Term premiums have actually also been coming down lately, but we think we'll expand it into next year.
Darrell, good to see you.
You too, John. Thanks.
Thanks for being here. Thank you, sir. Darrell Cronk there of Wells Fargo. Yields are lower this morning, at least. We're down 5 basis points across the belly of the curve, down by almost 5 now on 10s, 4.07% on a 10-year bond yield. The equity market near session lows. Let's give you an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Walmart announcing a change in leadership ahead of earnings next week. The company announcing CEO Doug McMillon will retire at the end of January next year. John Furner will take over as CEO on February 1st after serving as the company's executive vice president and CEO for Walmart US. Furner first joined the company as an hourly associate back in 1993. Meanwhile, President Donald Trump is readying substantial tariff cuts to address high food prices. The president unveiled frameworks with Argentina, Guatemala, El Salvador, and Ecuador to reduce tariffs on common grocery items. The deals will reduce tariffs and barriers on items like beef, bananas, and coffee beans in a push for affordability. And StubHub shares are plunging down 18% after the ticketing platform failed to provide guidance for its current quarter in its latest earnings report. Its CEO said the company plans to offer an outlook for 2026 when it reports fourth quarter results. This was the company's first earnings report after going public in September. That's your Bloomberg Brief. John.
Yahira, thank you. More from Yahira later this hour. Up next, the morning calls, plus Jay Goldberg of Seaport with the loan sell rating on NVIDIA following mounting AI bubble fears. Jay's going to join us in just a moment. Live from New York City this morning. Good morning.
We are in the midst of a major technological transformation that sure requires a lot of chips and requires a lot of data and data centers, but also requires a lot of energy. So the technology and the energy are combining in a way that we're seeing job reductions, but at the same time, we're going to see a massive increase in power bills.
Will we see some pushback to the AI story? We're starting to see it in the equity market. We're down 1% on the S&P. We're down by 1.45% on the Nasdaq 100. If you're just joining us this morning, this is better than it was about an hour ago. In the bond market, a bit of an offset coming from fixed income now. Bond yields are lower across the curve. 2s are down by 4. Likewise on 10s, we're down by 4 or 5 basis points this morning to 4.07%.
Yeah, you are seeing buyers come in, given the fact that there is this risk aversion. There's so many cross currents this morning. On one hand, you've got the tech story, a question of how much you really are seeing, some sort of gut check about the build out of tech. And then you have this Walmart story heading into earnings next week, which really is fascinating. The idea that the CEO, Doug McMillon, is stepping down and he's going to be replaced by the former head of Walmart US. So he's going to be the new CEO. And it raises a question, why do this now before earnings, right? The timing of it's raising questions, the nature of it's raising questions, which is the reason why maybe you're seeing the shares add to the sell-off and add to questions about the state of the consumer and how much this has to do with anything going forward on that front.
Stock is down by 2.7% in early trading. Numbers from Walmart coming next Thursday. Look out for that later next week. Let's get you some morning calls. First up, Wells Fargo raising its price target on applied materials to $255, remaining positive despite current weakness. Your second call from Baird initiating Microsoft coverage with an outperform, highlighting double-digit revenue growth potential. And finally, Morgan Stanley raising its price target on Nvidia to $220 ahead of earnings, citing strong demand signals. That name this morning down about 3%. Let's stick with tech. The Nasdaq 100 on track for back-to-back weekly declines as valuation concerns grip Wall Street. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, we've been spoiled. It's up and to the right pretty consistently over the last several months. What do you make of this move lower in the past 2 days? I think Mandeep Singh's got a problem with his microphone. Mandeep, you're going to unmute. You're going to make it happen?
Yeah, so look,
there we go, buddy. You're the tech analyst, Mandeep. Get the tech right. Come on.
Yeah, the unmute
Come on. It's a
button.
credibility
Yeah,
gap there, sir. Carry on, Mandeep, please.
Look, when it comes to the CapEx spend, you've seen, these hyperscalers go from $50 billion in CapEx to over $100 billion. And now we are talking about over $150 billion in CapEx per quarter. So when you see numbers like this go up, the ROI question will constantly be asked. And then in that case, you have to look at the quality of the backlog that these companies are generating. And a Microsoft backlog will look far better than an Oracle backlog, for example. And that's where, you will see these kind of stock moves where investors will react because they are anxious about the ROI. But there is no doubt that the demand is there. It's just a question of who will do better in terms of realizing it sooner. I think Microsoft is an example that will realize it sooner, but Oracle, it may take longer. At the same time, the the supply constraints are there. And so from that perspective, the semiconductor infrastructure players still look pretty good.
At this point, the demand for some of the AI services is certainly very high, and there isn't enough supply to meet it. Is the demand for the debt tied to some of these companies, for the ability, the privilege of being able to pay for this, is that still as strong as it has been?
Well, so when it comes to the debt side, look, the neoclouds like CoreWeave, Nebius, and all these companies, they are the ones that have, a rental business where they're buying chips from NVIDIA. They don't have their cash. They have to raise money. And so the fact that they're able to do it and then translate that into a backlog, in fact, CoreWeave's backlog grew 3x this quarter. So from that perspective, again, as long as the demand is there, you will see these companies sign up long duration contracts. And when you see, an equilibrium reach in terms of the market dynamics, that's when the backlog growth will slow down. And I think that maybe at that point of time, the market will start to just kind of slow down in terms of new issuance. But there is no doubt that right now, power, infrastructure, these are real constraints. And so that's where you are finding all the financing you need.
Mandeep, thank you. Mandeep Singh there of Bloomberg Intelligence. Mandeep, thanks so much. Jay Goldberg of Seaport remaining cautious, writing, "We think we're in a bubble. The level of exaggerated rhetoric around AI is steadily getting louder, and when the spending contracts, it will ripple across the broader US economy." Jay joins us now for more. Jay, welcome. I wanted to talk to you about this all week. That very odd, awkward question to Sam Altman about your revenues here, your spending commitments are right up there. And he turns around and just says, if you don't like the stock, sell it, someone will buy it. Jay, I just wonder if you saw that exchange, how uncomfortable it made you feel and what it means for the broader ecosystem.
I did see that exchange. It did make me, it raised a lot of questions for me, right? I'm not as optimistic about near-term demand for services, about near-term demand for AI. Again, I love the technology. AI is going to be important someday. It's just going to take a while. And my industry, semiconductors, are cyclical. They go up and for a long time, but they can also come down. And I think there are a lot of warning signs. There's a lot of froth in the system, and I think it's reasonable to be a little prudent here.
Jay, what's the number one warning sign for you? What's the big flashing red light that gets your attention, that you keep calling people up and saying, "Look at this, look at this"?
I think it is these increasingly elaborate Byzantine financings around these neoclouds. Those are getting to be some pretty complex structures. CoreWeave and Nebius, yeah, they both have big backlogs that's growing, but like, what is the quality of that revenue that's coming in? How do we value that? I think there are a lot of questions around that.
Jay, is this a valuation story or is this an existential story for some of the less solid players?
I think right now there are probably 200 neoclouds. I mean, the number I hear keeps growing. That's just a big number, right? So I'm worried about the sustainability of all of those. There will eventually be consolidation there. The debt markets will force that. I don't know exactly when that's going to happen, but I do think that it is unsustainable at this current structure.
Given the fact that there is a significant build out of debt and these elaborate financial structures, as you've said, how much will this reach into the echelons of NVIDIA and Microsoft and Alphabet? And how much do you expect this to stay relegated to the CoreWeaves of the world, the Applied Digitals?
So I think ultimately it gets felt all the way up. I think the problem I have with the current cycle is that it is so narrowly concentrated. If you look at all these deals that are taking place in the neoclouds, in the broader ecosystem, it all comes back to spending from the same 6 companies, right? Google's and the Microsoft, Amazon, Oracle, OpenAI, right? That's a very, very narrow base for this huge cycle. And I think ultimately what will change is at some point, some of those players will start to rethink their spending or shift it elsewhere. And that will sort of ripple. That's where I see the rippling taking place is as those 6 spenders change their behavior. They can't keep spending like this forever.
Yeah.
And at some point that will alter the way this trade is taking place.
Jay, I've got about 30 left. I wanted to squeeze in this name, Apple. Jay, Apple has sat a lot of this out. Do you like that name for that reason?
I like Apple in the near term. I think their cycle is doing well. I think they have some good phones on the market right now. But that's to me a fairly short-term trade. Longer term, the AI questions for Apple are pretty serious. I just think they have time to address it. They still have a year or two to sort it all out, but they need to eventually get working on that.
Jay, thank you, sir. It's good to hear from you. Thanks for checking in. Jay Goldberg there of Seaport. Apple also down this morning by around 0.7%. The bigger hits, though, going to NVIDIA down by something like 3%.
Yeah, I think you raise a great point, though. This is sort of the bastion of stability at a time where there are questions around the debt structure tied to artificial intelligence. The bug was for Apple that they hadn't invested enough in artificial intelligence. And now, evidently, that's the feature.
That's what happens when you pull back by 2 to 3%.
Exactly.
The S&P 500. Story changes quickly. Bears celebrate 2 to 3% move after everything's gone up and to the right. Oh, yeah.
They've already all capitulated. They don't even exist anymore.
The opening bell is about an hour and 5 minutes away. We'll be catching up with Michelle Meyer of Mastercard on how plunging consumer sentiment has hit spending. Plus, the latest on Walmart. That name is down 2.7%. Some weakness on the screen this morning. The opening bell about 60 minutes away. Equities down across the board. On the S&P, we're down by more than 1%. On the Nasdaq 100, negative by 1.5. In the bond market, 2s, 10s, 30s rallying this morning. That rally picking up in the last 90 minutes. We're down 5 basis points on 10s. We're down 4 on 2s to 354.94. Some pushback from Fed officials in the last 24 hours and some pushback from Andrew Hollenhorst of Citi just moments ago, Lisa. Yeah. Fed cuts are underpriced.
Yeah, and it seems like that's actually consensus right now for a lot of different investors who are saying they might talk a big game about being hawkish, but in reality, they are going to cut rates. And I have to say that the news over the past couple of days and building right now would actually edify that because the stock market's not the economy. However, when the stock market goes down, that might reduce some of the fervor in the high income earners that have actually been feeling pretty good because of their stock gains and spending a lot and supporting this economy.
CPI is difficult to collect. Got that. OK. We're not going to have unemployment. Got that. We're going to get payrolls. Payrolls has been dreadful all year and keeps getting revised lower. So by the time they get to their meeting on December 9th, decide on December 10th, if all they've got to go on are these bad payrolls figures, who's got a stronger hand at that meeting?
Yeah, especially if you see any kind of wobble like what we're seeing right now continue. I will just say, what happened to when payrolls without the unemployment rate was useless? Remember when people would say that? They'd say, even Jay Powell was saying he was focused more on the unemployment rate because it was so hard to gauge the actual supply of workers at any given time. Now we're going to get the absolute number and that's going to matter because that's all we have. I'm sorry. Bear with me.
We don't know what the break-even rate is, so no one really knows what a good or bad number actually is on payrolls.
Moving target. So pick your poison, take a dart, throw it, and most people are saying it will equal Fed rate cuts.
It's going to be fun when we finally get that economic data from BLS. Equities down by more than 1% with your movers into the opening bell. Here's Yahara with more. Hey, Yahara.
Hi, John. What a morning. We start with Walmart shares. They are falling 2.5% in the pre-market on a leadership shakeup. Doug McMillon, the CEO, will be stepping down. He's been in the role for more than a decade, and John Furner, the CEO of Walmart US, will be taking the helm. This, of course, the timing is raising questions as it comes just ahead of their earnings report next week, plus this idea that Doug McMillon really brought this company into the digital age, transforming it into an e-commerce and digital powerhouse. So what will happen when he leaves? Meanwhile, we are tracking the deepening sell-off. We are seeing shares of Tesla, Nvidia, and Alphabet all lower in the pre-market. It is these tech names, these AI darlings that are leading us lower as investors get hit by a perfect storm, whether it's skepticism around whether these AI investments will be paying off, plus uncertainty over the Fed and a lack of data that we've had. So we are on track to pile onto yesterday's losses. And not helping sentiment is Applied Materials and their earnings. Their shares are falling 7% in the pre-market after reporting another quarter of falling sales. This is a company that builds the machines that build semiconductors, and it says export curbs to China are hurting demand, and it expects that drag to continue this quarter as well. John?
Yahara, thank you. Thanks for the update. More from Yahara a little bit later this hour. Let's turn to the Federal Reserve. Hawkish comments from Fed Presidents Neil Kashkari, Beth Hammer casting down over the central bank's December meeting.
I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
Joining us now is Bloomberg's Mike McKee. Mike McKee, that's a chorus of Fed hawks in the past day or so.
I don't know how much of a real dispute it is. It is people staking out different feelings about what the economy needs, as you guys were talking about. But there's still a month to go. And I wouldn't say necessarily that we're not going to get at least part of the jobs report and at least part of the CPI report. It is certainly possible. Plus, we should get the PPI, and that should give the Fed a pretty good idea of where we are. But this is what happened this week. The only person saying we're going to definitely cut rates is Stephen Myron, and we knew that. Mary Daly taking a middle route, but as you noted, Neil Kashkari switched from saying 3 cuts this year to maybe just the one that has passed and we won't do anymore. And that scared people in the market. You got 3 people who came out speaking this week who said we shouldn't cut at all. And so markets have at the moment priced out December, but as you know, we're going to have a whole lot of economic data released by the BLS and BEA in the next couple of weeks. And who knows what it's going to tell us and what these people are going to be thinking by the time we get to December 10th.
Mike, I kind of understand what it means to get part of the jobs report because one survey goes into one data point and another survey goes into one more. What does it mean to get part of the CPI report? What does that mean?
Well, there are a number of categories where most of the data would come in, and a good one is housing because the BLS can call home builders and find out what prices are. They can call realtors and find out what homes sold for. So they can get that data. They can get car data from automobile companies and automobile dealers. It's the consumer products that you find a lot of places that people are buying that they won't have. But the majority, well, not the majority, 38% is what I'm told, is data that they could get very easily or already would have in hand. So they could put out some sectoral CPIs if they wanted. And that might be something that they want to do in order to keep the series going, not break the series, as well as help the Fed.
Mike, thank you, sir. Mike McKee with the update on what we might get from the BLS and when exactly we're going to get it. This is complicated. You know how much? Like, just think about real life. How difficult it is to change someone's mind. OK? How difficult it's going to be to change someone's mind at the Federal Reserve when we're not going to have much economic data to do it.
Yeah, well, I think we found out that they don't really have an opinion on anything right now. So it seems like the mind aren't made up except for on a couple of corners of the Federal Reserve, the FOMC. So that's ultimately the question. But you're right. Is there a bias here? And if there is it going to pervade? And this is the bias that people think will pervade, which is it's going to be a Fed rate cut.
A Fed rate cut on December 10th.
And that's what Andrew Hollenhorst is saying, and that's what a lot of people in markets are saying, especially if you see what we have seen over the past couple of hours continue over the next couple of weeks.
I take the view that this is exactly where Chairman Powell wants us to be. Coin flip, two-way risk. And that was the intention of what we heard in the news conference at the last meeting.
Evidently, Operation Success, the Fed speak, allowed people to really get around the idea that maybe there really is uncertainty and it really will be a coin flip.
It is far from a foregone conclusion. And that's exactly where he wanted it to be. Let's turn to the consumer. Wall Street preparing for retail earnings next week. Meyer of the Mastercard Economics Institute writing hiring has slowed, but firing remains low. Weaker consumer sentiment doesn't seem to be showing up in aggregate spending. Michelle joins us now for more. Michelle, good morning.
Good morning.
Some of the spending behind the Kashkari switch in the last couple of weeks, the last several months. Are you seeing robust spending just continuing at a steady level, or is it picking up?
So it's been quite interesting to monitor consumer in real time, especially in the absence of the Census Bureau data as well, talking about the lack of data. So for us, we've been really, really squarely focused on what we're seeing in terms of real-time spending metrics. And it's been robust. So when we look at October, our spending pulse measure, which represents payments, spending across all different payment types, so it's comprehensive, is at 3.5% on a year-over-year basis for October. So it's strong. It's actually an acceleration from September. When we dig even deeper and look at the weekly data, the month started off a little bit softer, but the second half of October was this really, really meaningful acceleration across a number of categories. So it is hard for me to see an economy that is not continuing to move forward in a world where the consumer is still so engaged.
How much do you get a sense that the increase in spending is tied to more goods that people are buying versus increased prices of those goods?
So it seems like it's probably a little bit of both. So we are seeing, particularly in October, there was quite a lot of strength in apparel spending. That was one of the categories that really stood out with strength. And that could be partly pricing. We know that there's a heavy import share there. Tariffs are being passed on to some degree, presumably modestly. We'll know more once we eventually get some CPI data. But so I think it's a little bit of a pricing story, especially relative to last year when it was a heavily disinflationary, even deflationary economy for a lot of these goods.
I'm just wondering whether there also has been this concentration in the upper income sphere, if that continues to be driving all of the increases in the strength that you're seeing, and how much that's been on the heels of what's happened in the stock market. I mean, can you draw a direct correlation between spending at the high end and what we've seen in AI stocks?
Yeah. The upper income consumer always has a greater cushion. Right. They're relying on what's happening in the labor market, of course, in terms of their income, but they have this buffer from their balance sheet, and their balance sheet has been very supportive when you look at the move in the stock market, you look at the appreciation of housing assets as well. So they have a positive wealth effect that they can realize. I don't think day-to-day fluctuations are going to make much of a difference, right? The literature shows that consumers respond over a period of time of wealth accumulation, and that's when they start to adjust their behavior, when they feel like they have a persistent wealth gain. But it can impact confidence on the margin, perhaps.
On occasion, we've seen company after company come out and say they're struggling to pass on high costs to the consumer. Mm-hmm. We saw that from some fast casual restaurants. I think Chipotle is a great example of that.
Right.
Tried to put up prices like 1% in California, and there was pushback. Are you seeing signs of the same thing?
I'm seeing signs that this is a consumer that is very, very savvy right now. Right? The consumer knows that they have the decision to make as to whether or not they want to absorb those higher prices, because there's so much price discovery that's happening right now, especially in a world where there's so much technology, there's so much e-commerce, and there's so much information out there. So it's no longer the case that the consumer walks into a store and says, this is the price, I must buy this if I want this good. They can search, they can figure out how to optimize their purchasing power. And I think we're seeing that in a significant way right now, especially after we're coming off of the pandemic-induced price increases, which took them for a shock because there was such a long period of low inflation. All of a sudden, prices jumped up in the pandemic. They've responded to that. They've reacted to that, and they remember that. And I think that is influencing how much consumers are willing to accept pricing now.
How difficult is it to speak about the consumer in aggregate, given the fact that you're seeing dispersions in income, but also in regions, different regions, different political groups? There just seems to be these massive divergences that create a real noise underneath the averages.
For sure. That's always the case. I think because we have this unique data where we can cut the economy in a quite a granular way, I think it does provide additional perspective for us, and that's quite helpful. So on a regional basis, the Southeast has been outperforming for some time. So if I look specifically at October, we are seeing particular strength in Tennessee, in the Carolinas, in Florida, the fastest acceleration of spending across a variety of categories. And that's consistent with what we've seen in terms of job creation as well. Whereas in other parts of the country, certainly it's a bit softer. Parts of the Midwest over the last few years has been a bit softer as well.
Can we do Fed guesses with you still?
Yeah.
Are we
I mean, what economist doesn't like that game?
Of course, lean in. Best guess for next month.
I think more likely than not, they'll likely lean in the direction of cutting. But to me, it's the characterization of the cut that I think ultimately is going to get them around to moving and have that consensus on the Fed. And what I mean by that is that it will not be described, and frankly shouldn't be described, as an easing of monetary policy, an economy that needs lower interest rates because there's something really problematic in the economy. I think it will be discussed as the fact that we are still removing the restrictive policy that was put in place when we had a much different economy. And now the economy has changed. We've learned a lot about pricing. We've learned that the concern over tariff-induced shock to prices didn't play out, that it's going to be slower, that it's going to be more measured. And in the interim, we've seen a labor market that has slowed down in terms of the churn, which also means you don't need as restrictive policy.
Michelle, good to see you, as
Always
always. Thank you. Spending looks good, apparently, over at Mastercard. Michelle Meyer of the Mastercard Economic Institute sharing some of that data with you. On tariffs and the pass-through, Ambassador Greer speaking to the American press today. Time to take off some tariffs on products not made here. Banana, coffee, cocoa. Those tariffs and that relief is mutually beneficial.
Yeah, and I'm actually really interested in some of the relationships on the back of that. We just heard that Argentina and the U.S. are normalizing relations or creating some easier ties there. I wonder what other kinds of agreements there are to try to lock in some additional kind of geopolitical issues in addition to lowering the tariffs on banana, coffee, and cocoa, which will be welcome to anyone who is waking up this morning.
A lot of people have been complaining about the price of coffee.
Yeah, well, I mean, you've got to be awake to really keep track of this all.
Very expensive. Equity session lows were down 1.2% on the S&P 500. With an update on stories worldwide with your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Verizon is discussing plans to announce job cuts that could downsize the company by as much as 20%. The planned cuts could impact up to 20,000 workers and are part of an aggressive strategy to reclaim market share. The Wall Street Journal also reporting the company is planning to convert 200 company-owned stores to franchises. Meanwhile, Amazon and Microsoft are lining up against NVIDIA. The Wall Street Journal reporting the two companies are supporting legislation that would require chip companies to satisfy U.S. demand before sending products to China and other countries subject to arms embargoes. NVIDIA is fighting the legislation. And baseball's most valuable players have been crowned. In the National League, LA Dodgers phenom Shohei Ohtani won his 4th MVP award and 3rd in a row, winning in a unanimous vote. In the AL, Yankees slugger Aaron Judge won his 3rd MVP, beating out Mariners catcher Cal Raleigh. It's the first time in history that both MVPs repeated in back-to-back years. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead, plus Mana Mahajan of Edward Jones on why the equity pullback could be a healthy sign from New York City. You're watching Bloomberg TV.
When it comes to tech, you're seeing large issuance come out. Investors still say they're going to be able to do what they're doing. That's a lot of positivity coming from these companies, but yet at the same time, we're hearing builders can't deliver on data centers. There's not enough energy and power for some of these data centers. So I would be a little more skeptical than maybe the average investor.
What do they say? Price sets narrative. A lot of bearish takes this morning. Given this tape right here, we're down 1% on the S&P. We're down by 1.6 on the Nasdaq. On the Russell, Small caps down by 1.4. As we count you down to the opening bell with this sell-off in mind, look ahead to today and next week. Some Fed speak today, Schmidt, Logan, Bostic. Tuesday, this is when earnings start to pick up. Home Depot. Wednesday, you're going to hear from Target. You'll also hear from Nvidia later on in the afternoon. And on Thursday, Walmart. Walmart in focus now with a change to leadership as well. That is one to watch.
Yeah, especially because this morning Walmart announced that Doug McMillon, the CEO, who's 59 years old, is retiring. The head of Walmart U.S., John Furner, is named as a successor coming into force. We do expect Walmart CEO Doug McMillon, who is stepping down, to remain on the board and stay there until 2026, raising a question of the timing of why now, especially given the fact that Doug McMillon was widely considered to be quite successful in terms of turning around some of the strategy at the U.S. biggest retailer.
So look for Walmart on Thursday, and I'd also say this on that calendar. Going to fill some gaps on that calendar in the next few days when we find out when that payrolls report for September is going to drop. So watch this space. Let's turn back to the equity market sell-off. Concerns about tech valuations putting a dent on equity futures. Mona Mahajan of Edward Jones writing the fundamentals of the AI story, in our view, remain intact. And after a powerful rally since April, we believe a reset for these names could be healthy. Mona joins us now for more. Mona, welcome. What's healthy about this move?
Yeah, thanks, Sean. Look, after a 55% rally in the NASDAQ since those April lows, we went up almost in a straight line without a 5% or higher correction. So in our view, could we be due for a period of profit taking, a little bit of consolidation, especially as we're headed into year end and investors are thinking about where are their gains? They're also thinking about positioning for 2026. Now, all that being said, healthy reset, yes. Is the story over? We don't think so. But the case for diversification, we think, does become even stronger in the year ahead.
Mona, what is a healthy reset? So this is a 3% pullback on the S&P. What's a healthy reset?
Yeah, look, we know in any given year, corrections in the 5, 10, 15% plus range for those higher beta parts of the market are the norm. And in fact, this year we got one pretty severe, almost 20% downturn in the S&P 500 earlier in April. We haven't gotten another one yet. But what gives us some confidence that a pullback or correction doesn't turn into a deep or prolonged bear market? Well, a couple things. One, usually those occur historically when the Fed is aggressively raising rates. And in fact, during the dot-com bubble in the late 1990s, that's what kind of killed the tech rally in those years, of Fed aggressively raising rates, or you're heading into a recession or a deep downturn. And we don't see either of those scenarios on the horizon. So it gives us some comfort that these pullbacks and corrections won't turn into something more nefarious and maybe provide some opportunities.
Mona, this maybe is in the stock space. Do you think that it's a different story this time in the credit space, given that suddenly we're seeing a different tone, particularly when it comes into financing some of the AI build out?
Yeah, it's a great call out. And look, that has been part of what has been weighing on these stocks over the last few days. Certainly, we are seeing companies like Oracle, which, by the way, were not part of the Mag 7, were not as cash rich as the Mag 7 were. And in fact, were more debt burdened heading into this cycle. They have taken on more debt and their leverage ratios are not looking as attractive. And you can see that in some of the CDS reaction for that name in particular. But more broadly, we are seeing companies like Meta, like Google, take on more debt to finance some of this tremendous CapEx spending that they've projected for 2026. Over time, could that weigh on margins and free cash flow? Potentially, yes. And so I think that is part of the new narrative that has been emerging. Companies raising debt, companies going from being asset light to asset heavy. And I think that shift may weigh on some of the valuations we've been seeing.
How does that affect your investment strategy when it comes to corporate credit, when it comes to the debt equity mix in your portfolios?
Yeah, certainly from an equity perspective, what we are saying is it is important to have exposure in the U.S. to both the large cap space and the mid cap space, which we think does have more scope for valuation expansion potentially and some catch up. From a sector perspective, we like both growth and value parts of the market. So if you are adding new money, putting new money to work, sectors like, we think, healthcare, industrials, to complement or alongside some of the tech and AI. And to your point on credit, we continue to favor parts of the investment grade market. We're not really extending duration at this point, given some of the moves lower in yields. And we continue to see neutral on credit quality. In fact, a little bit cautious on the high yield space here. So broadly, we still like equities versus fixed income. Within equities, we want to be diversified and probably shorter duration on the credit side as well.
Mana, appreciate the update. Thank you. Mana Mahajan there of Edward Jones. Going into the opening bow with equity futures down across the board here. The S&P 500 down by close to 1%. Lots changed this week. Fair bit of pushback from the Federal Reserve on market pricing for interest rate cuts in December, and a bit of a pivot I think we've got to track from this administration as well. On tariff relief, on tax rebates, there's a change in tone coming from the White House, and it started over the weekend and it's picked up through the trading week.
Yeah, there are a number of different strains here, and it's hard to put them all together. On one hand, you've got the Fed pushback, the idea that maybe a rate cut isn't warranted based on, guess what, inflation. Then comes the response from the administration on, guess what, inflation, cost of living, this concern that the administration really is emphasizing after the midterm elections that really highlighted that as an issue. And then you've got the tech overlay, this question of, is this time different, with debt financing really in the forefront of some of the wobble that you are seeing in some of the big tech names, a question of how much tolerance there is by credit markets to finance this.
That's one to watch going into the opening bow. These headlines just crossing from the US Trade Representative, Ambassador Greer. Ambassador Greer saying the US to lower the tariff rate on Swiss goods to 15%. Switzerland agreeing to invest $200 billion in the United States economy.
So this comes after a lot of disagreement, and I'm sure it was welcome for Switzerland. I want to understand more about some of these investments in the United States that we're hearing from a lot of different countries. So let's wait for more details on that.
It's been a long week, hasn't it? Hey.
Can you tell?
For you and I both. Coming up on Monday, Russ Kostrick of BlackRock, Torsten Slock of Apollo, Henrietta Trays of Vader Partners, Abigail Watt of UBS. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 5 at the NITO ATP Finals. Carlos Alcaraz clinched the year-end world #1 ranking with a comfortable win over home favourite Lorenzo Musetti. The victory was his 70th so far this season. That's a career high for the 6-time major champion. Earlier, Alex de Minaur secured his spot in the semis with a crucial win over Taylor Fritz. He'll face Jannik Sinner for a spot in Sunday's final.